6 to 9 months from now, we're going to have put the term disinflation up on the shelf with the term transitory.
A lot of people are looking at 23 as very much a transition year.
You're looking at this data and you're saying the puzzle pieces are not fitting together.
We've got basically a 50-50 chance, we think, of a soft landing versus a mild recession.
We can probably skirt around a recession. If we have one, I don't think it'll be very bad, and I don't think it'll be very long, but my base case is we dodge it altogether.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Almost stayed in bed this morning, Tom.
But you had to take a lift.
Well, very close. It's just like the snooze before the inflation report. Do you know
It is. It is a snooze fest, but we need to make it productive. There's a lot going on beneath the snooze
We need to make it productive.
That's our job, is to stay with us on this exciting Friday.
Usually saving that pep talk for the moment before we come on air. Good morning. Good morning. From New York City, this is Bloomberg Surveillance with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures down about 0.4%. If you want to move this morning, look to the commodity market. Crude this week is up by 8.5%. The Russians are preparing to cut output. And Tom, as we understand it, according to delegates of OPEC Plus, they won't boost supply in reaction to that Russian cut. So you've got a decent rally this morning in crude.
It's been a story all week here, and it's noodling up from what I think 79 for a cup of coffee. Brent crude up to 86.23. And what's important is not where it is, but it just won't pull back. I mean, it just won't give way. I don't care what the timeline is of the glide path. We're on our way to 90.
Relentless. Do you have to reframe the inflation report next week, Bramo?
Well, this is really one of the big questions, especially if that's going to torpedo any kind of equity momentum. But just to build on this move in oil, what strikes home to me is how much the barrels have not been taken off the market from Russia. How basically all they're doing is losing some of the profits from the cost, but not necessarily selling less. And if that gets taken off, do we get a changed narrative around oil and gas and how that feeds into some of the inflation metrics?
I saw Goldman and Jeff Currier just pushing out that triple-digit crude call.
Yeah.
What, to year end?
Yeah.
Something like that?
Something like that. And a lot of people have been burned again and again in terms of a lack of a rally in oil prices. Could this shift that narrative just a touch?
Should we talk about who's getting burnt right now? Can you bring up the chart? Lift in the pre-market. Brutal.
It's the way it's in the pre-market, a series of
Lift
lower
is
lows.
down 33%. Now, year to date, coming into this stock was flying by about 47%. I think we started the year around 10. And Tom, we're going to do a full round trip by the time we open. If we hold these levels, we'll be back to the 10 kind of level.
It's scale. And this is one of those places where there's two. It's a duopoly. I get it, except we saw this with Uber. I'm going to call it success, and Lyft not. And the answer is, by one publication, 70% of the market is Uber. I don't buy that. I think it's even more.
Is it a winner-takes-all situation? I think we reflected on this earlier this week when Uber came out. Used to talk about Netflix that way. Can only one person win the streaming wars? Is that where we're at now with this kind of industry?
This is actually more extreme than a Netflix type of scenario, simply because in order to compete, in order to break in, they have to cut some of the fees, which means that perhaps their margins are going to get cannibalized, which means they can't necessarily invest in some of the advancements and innovation that is necessary to keep taking market share. And this is the concern and the reason why the shares are dropping the most, going back to the IPO.
It's not going to be Theory Friday. We're going to do a lot of good discussion. Elsa Lingo's coming up, and we'll dive into thinking about all this over the weekend into Wednesday's inflation report. But John, I'm going to make it as simple as I can. On the internet, into your really important question about is it a survivor of one, is Michael Mabusian's landmark essays pushing back 12 or 13 years ago. It says in technology, using Ethernet mathematics, it is a survivor of one, like Amazon would be one example.
The stock right now down by about 33%. We'll pick up on that story a little bit later. Equity futures down 0.5% on the S&P. No real drama here. Into the bond market, we look a little something like this. The 10-year, close to 370, up 4 basis points. TK, the 2-year, back through 450.
It's right where I want to go. It's the first place I looked this morning. And again, it's like oil nudging up to 86, Brent crude on its way to 87. There you are, 4.51% in the 2-year. Okay, it's boring as we wait for inflation, but you know what? Markets are moving.
The spread between the 2-year versus the 10-year, the inversion of that curve. Lisa, right now, negative 81. What were we yesterday? Negative 85?
85.
Levels we haven't seen for a long, long time.
Yeah, the deepest inversion that we've seen since the early 1980s. What are you saying there's no drama? There's the University of Michigan sentiment survey, which we've all been on tenterhooks all week for, at 10 a.m. that's going to be coming out. And this is really, I'm focused on the actual reading. How much does it rebound or not in tandem with lower gasoline prices? But I'm also curious curious because we're expecting a higher year-ahead outlook for inflation. This, to me, will be interesting, moving in the opposite direction. Have we reached this feeling, peak disinflation talk, peak immaculate disinflation narrative in markets? Today, we also have the European Council meeting in Brussels. They're discussing Ukraine and the European response. There was a lot of drama overnight. We can get into that later. But they're also talking about the response to the U.S. Inflation Reduction Act. And I really am curious to see whether there's any cohesion around some sort of subsidies on their side, some sort of program on their side to compete, or if this is just going to end up being a point of tension for a long time, a talking point. Today, there is a bunch of Fed speak. Fed Governor Chris Waller around 12:30 a.m. and Philadelphia Fed President Patrick Harker. Do they double down on the groupthink, which seems to be what's going on, John, in terms of we've got to go more? Do they push back? What kind of narrative do they give going into that Tuesday report, which is going to be a blockbuster one for not only CPI, but we also get some sort of read, John, on who the potential next leader is of the Bank of Japan?
Lisa, thank you. Let's talk about that potential next leader of the BOJ, a professor and former Bank of Japan board member, Kazuo Ueda. And Tom, as we understand it, according to Mizuho, so I went straight to the local bank research, as I'm sure you did as well. Mizuho say this about him: he's a cautious person, so I'd say he won't take away YCC, yield curve control, all at once. Dropping YCC will be likely his first mission, with a balance of the tightening effect in the real economy and the financial conditions by the proposed deputy governors.
They are data dependent, but different data dependent than we are. There's a cultural overlay here. I've been in the offices of the Bank of Japan. This is not the Eccles building. There's not Bloomberg sitting on the desk. There's a quiet, and the quiet is the slow motion movement that they work at. That's a cultural issue.
I'd go one step further. The government is highly involved, heavily involved in the direction of policy.
Is socialism? Is it some form of theoretical communism that we learned in school without tinges of Leninist Marxist theory? It's a communal approach to economics.
We learned very recently that when they were pulling back on YCC, or at least adjusting the band, Lisa, that apparently that meeting was stopped. And it was stopped so that the government can have a conversation, the government official who was in the meeting, about what was going on. Now, it makes you wonder the kind of process they went through to choose who would lead the BOJ and what it will mean for policy going forward from here.
Yeah, honestly, our colleagues over at Bloomberg Opinion put it really well. We're talking about the potential hawkishness of the new Bank of Japan governor, right? But to your point, any hawk on the Bank of Japan is an uber dove anywhere else, and they're going to only move at a glacial pace, if at all.
It's all relative, isn't it? We got some yen strength today. I think we do. Dollar yen, negative 0.5%, just in and around 131. Let's get to Elsa Linhos, Global Head of FX Strategy over at RBC. Elsa, can we just start there briefly? The next BOJ head, your thoughts on the recent reports that have come through all of this morning?
Yeah, absolutely. I mean, I think it's been an interesting trade for many since the YCC band was widened in December. Got to be honest, feels like people have overtraded it a little bit. You know, keep getting excited about who it might be, what that might lead to in terms of movement. But as you say, the Bank of Japan moves very slowly. And so I think traders right now weighing up their options. We saw that kind of overbaking of the move. It went dollar yen down, back up again, and now pretty much I'd say close to flat.
Elsa, your academics in mind is simple. There's disinflation, there's deflation, there's inflation, and then there's a cosmic undefinability of reflation. Mr. Kuroda is doing the ultimate reflation experiment. How's it going?
I mean, honestly speaking, it's been a long time and it's hard to see tangible effects. Yes, there is inflation right now in Japan, but we've seen it across the world. Global supply chain issues, commodity price effects. And what we see when that fades away is the underlying core inflationary dynamic, which is stronger in some countries than it is in others. And I've got to be honest, I find it hard to imagine a world where the US is in disinflation, as we're pricing at the moment, and Japan is seeing aggressive inflation that would require much higher rates. It's not a world that adds up.
So you're basically pushing back against the idea that perhaps next Tuesday is going to be rather explosive because we get both CPI and then we also get the Bank of Japan nominee, and some notes overnight were saying this is going to be explosive, especially for all the pain trade and people that are positioned in different ways. You disagree with that, is that correct?
Look, I think CPI is going to be interesting. There's obviously huge focus on spot CPI in the US at the moment. The Bank of Japan governor, perhaps less so. For me, the big change going on at the moment is not what's happening in Japan, but what's happened in the rest of the world. The increase in hedging costs for Japanese investors, I know we've discussed it before, that's not gone away. And even if the Fed were to be cutting in the back half of the year, it'll still be very expensive for your average Japanese investor. That's the sea change, not the YCC.
Elsa, how does your world change if we now have where money costs something? Cash has value. The one-year Treasury bill is out where it is. How does that change the foreign exchange world where you can advantageously profit from it?
I think that's a great question, Tom, because we're kind of in an environment where vol seems to be falling across the board. You see it in equity markets and fixed income markets, a little bit more mixed in FX, but it's an environment that is actually conducive to considering not just rate dynamics, but also the level of rates, static yield. And in that context, it's very difficult to imagine we're going to see the dollar collapse like I think a lot of people are forecasting if it remains the highest yielder in G10. It does matter when cash costs something. It costs something to short the currency. You earn something for just holding on to it. It does mean that holding on to a short dollar yen position, unless we see a dramatic fall in interest rates, it's just not going to pay off.
So just quickly, I just want to finish on Europe, the euro and what's taking place in the energy patch today with crude rallying. There's a piece in the Financial Times this morning, and it's on Pierre Andorran, who I'm sure everyone is aware of, the commodity trader, runs a commodity hedge fund. He says Putin has lost the energy war. Do you agree with that? Is that your working assumption for 2023, given what we're seeing play out this morning?
It's interesting because you actually mentioned the Inflation Reduction Act earlier, and one of the discussions they're having at the European Council today is what the response is going to be. The reality is that structurally cheap gas that Europe used to get is no longer there. And that might not benefit Putin, but it certainly will benefit the US in relative terms. So going forward, this is not a 3-month or 6-month trade, but if you look at it on a 2 to 3 year horizon, there are big incentives for European companies to be investing in the US.
Interesting. Elsa, thank you. As always, Elsa Lindos there of RBC. Thank you very much. If you're just tuning in, let's run through the price action for you. Equity futures a little bit softer on the S&P 500, negative 0.6%. The curve, 2s versus 10s, the most inversion, the deepest inversion going back to 1981, as Lisa pointed out a little bit earlier. The 2-year versus the 10-year, just off those levels from yesterday, from negative 85, Tom, to negative 81.
It's an interesting tape, to say the least. And again, I'm going to go to oil. I know Julian Lee coming up, $86.
Looking forward to that conversation, Tom. Yeah. Very close to 80 on WTI. That conversation up next.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. A surprise at the Bank of Japan. There are multiple reports that Prime Minister Fumio Kishida will nominate Kazuo Uedea to take over the central bank in April. That led to a jump in the yen. He is a professor and former BOJ board member. Ueda has expressed caution of raising interest rates prematurely. Reportedly, Deputy BOJ Governor Masayoshi Amamiya refused to take the job. In Turkey, 3 survivors were pulled from the rubble today, more than 100 hours after they were trapped by killer earthquakes. Rescuers had worked for more than 3 straight days. Meanwhile, the death toll in both Turkey and Syria has now climbed to 22,000. Russia has launched a number of cruise missile attacks on Ukraine today. Ukraine says the targets were critical infrastructure in several cities. Meanwhile, Germany's Chancellor Olaf Scholz has asked European leaders to deliver German-made tanks to Ukraine as promised. The goal is to have 80 of those Leopard 2 tanks there by the end of March. More revelations about that Chinese balloon that was shot down off the coast of South Carolina. The Biden administration is presenting evidence that the balloon was capable of collecting communication signals and carried an array of surveillance equipment. Bloomberg's learned that Congress has been told some of the components had English language written on them. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg.
Let's assume even if Russia doesn't lose any production, 1 million barrels per day more from China, 1 million barrels per day less from the SPR. that's a swing of 2 million barrels per day. I think the market's too focused on Russia. The other two alone can take us to $100.
And Rita Sen there of Energy Aspects, bullish on crude. Let's get straight to crude right now. Crude rallying up more than 2% on Brent, $86 a barrel on WTI, just short of 80. The latest news that Russia said it will cut oil output by 500,000 barrels a day next month. This is the follow-through we expected. They said they'd do this. The threat to retaliate against Western sanctions, well, here it is. Let's see if it materialises in the next 30 days. OPEC Plus, and I think this is the key point, how will the rest of OPEC Plus respond to their output cut? According to delegates, Lisa, they won't boost supply in reaction to that Russian cut. They're the headlines this morning.
Which is what Russia kind of wants, right? I mean, because essentially the point here is, well, if we aren't necessarily making as much money from what we're exporting, if we cut our production, we'll make the same amount by exporting less simply because the prices will naturally rise.
The crude's been rallying most of this week, Tom. Up 8.5% now on the week. A decent weekly turn. In fact, I think we're on course for the biggest weekly gain of the year so far.
Take the chart back pre-pandemic, $60 a barrel, and then you go down to 20 when Lisa had 2 drums, and she paid for 2 kids' school with that, with the drums in her living room, down to let's print it at $20 per barrel.
Which is then required.
And the important point here, John, is the persistency from $20 a barrel up to $120 was tangible. There was like a real trend to it. We come back to $70 a barrel, and now what?
Well, I
and
think
the answer is 70
here, Tom,
to 86.
is we're having a supply-side conversation.
Yeah.
And I thought we'd be having a demand-side conversation with China coming back online. So this is unhelpful. Let's put it that way, particularly with China coming back online. And we're all sitting here waiting, Tom, for that demand to show up.
Nice precursor off the Ferro Excel spreadsheet to Julian Lee in London, truly expert on the geopolitics and the mathematics and the microeconomics of oil. Julian Lee, John says it there, it's a supply-side dynamic, and also, as Amrita Sen said, a demand-side dynamic of the Pacific Rim coming back on. Which is more predominant right now into 2023?
I think, the immediate impact is perhaps from the supply side, and we've got a number of things that have happened in the last few days that have helped support this rally that we've seen this week. These terrible earthquakes in Turkey have had an impact. They have effectively knocked out the exports from Azerbaijan. That's about 600,000 barrels a day. We don't know how long those are going to be off the market for. There's investigations going on about potential damage to the export terminal for that, which is in southeastern Turkey, quite close to where these earthquakes happened. We've had what looks to be a brief outage of a little bit of production from Kazakhstan that also feeds into the Mediterranean market. So that's tightened that a little bit. We've had a production outage in the North Sea of the biggest field there is underperforming a bit. As Amrita said, we have seen the end of these sales from the Strategic Petroleum Reserve, and it's noticeable that if you look at the US weekly figures, the US has gone from being a big net exporter of oil, as it was for most of last year, to being a net importer now, if you combine crude and refined products together. And then we've got the sort of the opening up of China and the boost to aviation demand that I was talking about in the newsletter yesterday. But you have to counter that to some extent with downward revisions to some of the demand forecasts that had been made elsewhere on the back of fuel switching from natural gas to oil. Warm weather in Europe means that hasn't happened to quite the same extent. So that's offsetting that a little bit.
Julian, how does OPEC Plus behave differently, and particularly Riyadh behave differently if we leap over 90? The path from 80 to 100, how does their behavior change at 90?
I'm not sure that it does change very much. I mean, I think that, they've clearly over the last few months been worried about the downside. They've been worried about Brent around 80 and potentially below. They've been very cautious to protect themselves against that downside. If you look at when oil got up to 120 last year, this was a period of time where they had been lagging behind demand growth with their output increases. The group as a whole, as it still is, was failing to pump as much as their targets allowed because many countries couldn't. And yet, even then, they were very reluctant to allow those countries, Saudi Arabia, the Emirates, to make up the shortfall from others. And so they were clearly much more worried about prices slipping below 80 than they were about them going above 100. And I think that mindset continues.
Which really raises this issue. Why have none of the warnings come to pass of the oil bulls? Why has not China coming back online, an economy that hasn't been as bad as people have expected, in fact, hasn't even contracted the way that people thought, even in the United Kingdom? And then you also are getting supply reductions. Why aren't prices higher?
I think that it's partly that the market is just better supplied than it was. Yes, we haven't had some of the very dire economic forecasts come to pass, but there has been, I think, a significant reduction in demand, particularly in Europe. We've had a relatively mild winter in Europe so far, which means that the pull on natural gas hasn't been as big as people feared it would be, and therefore the need to switch away from natural gas and into burning oil hasn't materialized in the way that many people feared that it would do this winter. And that has helped to keep demand in check to some extent. And plus in China, I mean, yes, we've had the opening, but in many ways, the Chinese economy or Chinese oil demand is structurally quite different to oil demand in the US or in Europe, which is very focused on the transport sector. In China, it's much less so. Transport accounts for a smaller proportion of the country's oil demand. And so as you open cities up and allow people to travel, that doesn't have quite the impact that the same moves would have had if they'd happened in the United States, for example. And Chinese industrial demand for energy and for oil within that didn't take the same sort of hit that transportation demand did.
Hey, Julian, always a clinic with you. Thanks for this morning. Julian Lee there on the commodity
My
market
pleasure.
with Crude rallying. Thank you, sir. Brent up by 2.5%, WTI up by 2.5% as well. Check out the bond market in Europe. The German two-year yield, Tom, the highest since 2008. If you compare it to where we were last year, February 10th, negative 33 basis points. That is a 300 basis point move on a German two-year, and it totally tracks what's happened with the depot rate at the ECB, which has also seen a 300 basis point move, Tom.
Off the bottom,
this is just tracking the ECB. More rate hikes to come.
Off the bottom, I got negative 0.66%. John, why is it breaking out? It went up there a couple number of days ago, pulled back, and now we go out to 2.76%. What's the why? Is it
you
German
can focus
inflation?
on the change. You can
9%?
focus on the change in inflation from 10 to 9, or you can focus on the number. I think you focus on the number. 9. It's a problem.
Well, how much is this also really stemming from oil prices, right? If oil prices go up and you have resilience in the economy, you've got a double whammy. You've got an ECB that's forced to really combat inflation that doesn't come down as much on a headline level. But you also have the strength of other components aside from oil that are going to be driving some of the price increases. So it's a sort of toxic brew.
Is that what you want to call it? Look, I think Torsten Slok of Apollo started the week well with this. He said, are we reintroducing the risks of last year? Reintroducing the risks of 2022 with a better growth profile in the United States, a reopening of China, and maybe the crude issues come back. And I think maybe you get a bit of a scare off the headlines out of Russia this morning.
Which is the reason why some people are talking about a double-dip recession. I think that Tom Tsoutsouris was talking about that. This question around, okay, we've gotten the reprieve, we've gotten a rally. What happens if people kind of have to reset and the strength rejiggers the story that we were looking at the end of last year?
But truly, it's amazing, Tom. I remember the summer of 2014. I think I was over here with you, the summer of 2014 in New York at the time, and President Draghi took rates into negative territory, the ECB, for the first time ever. And since then, for years, the 2-year, sub-zero, consistently for years. And then last year,
the distinction with the ECB and their headlines is they set out a calendar. The Fed doesn't do that. I wonder what the 2025 calendar looks like for Lagarde.
Yields climbing this morning, crude rallying, more of that still to come. Live from New York, this is Bloomberg. Slow start for the equity market this morning. Good morning to you. Equities heading south on the S&P 500, negative by 5 or 0.6% through much of the last couple of hours. On the S&P, heading towards the biggest weekly loss of the year so far. Through Thursday at the close, negative 1.3%. The Nasdaq down by another 1.2%. Keep an eye on that as yields pick up worldwide. In the US, a 2-year, 10-year, 30-year looks like this. Yields higher by anywhere from 4 to 5 basis points. Your 2-year through 450 in the last 24 hours, 452. Over in Germany, similar story. Yields higher. Highest yields on a 2-year going back to 2008. And maybe, there's tons of things to blame, but maybe you can blame crude. Crude rallying hard this week, up by more than 8% on WTI. Tom, just short of 80 at 79.86, up by more than 2%. Russia pledging to cut output by 500,000 barrels next month. And according to delegates that we've spoken to here at Bloomberg, OPEC Plus not ready, Tom, to offset those cuts.
Yeah, I'm going to go out to Brent crude. The global price to me is way more important than West Texas. $87 a barrel rounded up moments ago.
Important for the inflation story next week in the United States. Earlier on this morning, we had inflation out of China rising 2.1% year over year, just as China reopens. William Lee of the Milken Institute says this about China. China's post-COVID recovery is the heart of upside risk to consensus forecasts on both global inflation and growth. However, and this is the important line, Tom, China's recovery may not spur a global growth rebound by as much as its past expansions.
It is Friday, and what we're doing is framing, and I get it on finance and economics, John. We're framing out the inflation report on Wednesday. But this is a really, really important conversation to get you ready for your thinking on the weekend of where we're going in 2023. William Lee is chief economist at the Milken Institute with public service to the International Monetary Fund, a tour of duty at Citigroup as well. And we're thrilled that Bill Lee could join us this morning. Bill, your opinion is courageous, narrow, and controversial. You think Wall Street is nuts about the China group think that they're going to come back and we're going to boom. Do you doubt China GDP of 5 or dare I say 6%?
A lot of the Wall Street consensus is looking toward high numbers of China growth rates, and even as high as 6 and 7% with the economic rebound we're about to have. But people are overestimating how hard it is to get the supply side back online, and the fact that the policy in China now is to emphasize domestic demand, domestic consumption. So if people are expecting the export engine of China to be reviving again and pushing up commodity prices, I think that's the wrong place to look. Look to the tourists from China going out. And Tom, we talked about the two Americas. Well, right now in China, there are 3 Chinas. The very rich will be the big tourists, the rising middle class that'll be engaging in some of that behavior. But the bulk of the population is worried about their wealth being caught up in the collapse of the property market, and the fact that their household income is in the doldrums because their youth unemployment rate is so high, their kids are not getting jobs.
I want to do the Bill Lee breakdown here, Bill. As you know, when I go to China, I go deep into China, which is 150 feet past the Mandarin in Hong Kong. I want to go into the way you think about the domestic politics, in that the Wall Street groupthink on China is wrapped around Shanghai and Hong Kong and Beijing, and you have the courage to go across the country. What is the distinction of Central and Western China?
I think one of the things that people have missed is the emphasis by Xi Jinping of wanting to spread growth throughout the country. And the Milken Institute's own study of the best performing cities in China has pointed to Chengdu as being an innovation center out west, a budding innovation center. And Chongqing has become a regional growth center that was supposed to be at the heart of the Belt and Road strategy. Well, the strategy to try to push growth out west is still there, but Western investors are ignoring that. And I think one of the things that we have to keep in mind is that China is more than the Mandarin hotels in Shenzhen, Hong Kong, and Beijing.
You tell him, Bill. You tell him.
Public service announcement.
Bill's been telling me for years.
That was aimed at you.
Bill's been telling me that for years. That's not news.
Hey, Bill, let's put some numbers on what consensus is. You know the function on the Bloomberg ECFC. Type in a country. I've put in China. This is the consensus forecast for 23, 5.1%, a snapback from 3 last year. Looking out to 24, the message seems to be get comfortable with 5% again in 2024. Can you put some numbers on your own forecast here, Bill, as you push back against that consensus 5%?
Well, I think the audience would say, well, who cares about Bill Lee's forecast? So let me go to my old authorities, the IMF. the IMF is very close to consensus almost all the time. But the fact that the IMF is looking to 2 handles and 3 handles out 5 years for China's growth tells you something about the reality of China. The IMF almost never deviates from consensus unless there's a darn good reason to. And I think that's a good evidence to say that we are not going to have the kind of high growth rates we had before because China's productivity and labor growth rates just aren't there to support the 5, 6, and 7% growth rates we've seen in the past.
Well, there are 2 different points here, Bill, and I'd love you to parse through them. There's the headline number that might be juiced by stimulus by the Chinese government, which we're seeing happen, as well as different types of regulatory policies. And then there is the stimulative effect on the rest of the global economy. Could it be possible for China to get headline numbers that they publish of 5% while also not having a stimulative effect on other economies because of the domestic focus of all of these programs?
Bingo, Lisa. I can almost guarantee you that the next set of numbers coming out of China's GDP will have very spectacular numbers on it, high 5s, 6s, possibly even 7s, because the rebound effect is going to be amplified by the way the numbers are being cooked by forecasters. But I think the reality is that China's policy is one of emphasizing domestic demand, emphasizing investment toward building domestic champions, companies that will be helping China's domestic economy. And so the focus on domestic consumption, especially in services, means that we're not going to see spikes in commodity prices. We're going to be seeing spikes in airline tickets and travel destinations and hotels. And that service sector constraint is something that's still very severe in China because it hasn't been built up as much as it has been in the West. So I think going forward, we should see inflation numbers rise, but in different areas. Even the current numbers that we're citing now, 2% inflation that just got released, most of that was food. If you look at the core inflation numbers, it's about 1%. So where is the spike that we're supposed to be seeing from the rebound? Not here then.
Well, so this is actually positive in terms of the potential ramifications for Europe in particular when it comes to crude prices as China reopens, but it has a pretty negative implication with respect to some of the growth that's being priced in to Germany in particular on the heels of China's reopening. How misplaced are some of those hopes?
I think a lot of them are very misplaced because, again, the policy of China that Xi Jinping announced after the Party Congress is we want to build domestic demand. We want to build domestic consumption. That's not the kind of stuff that makes for a lot of imports of BMWs, except for the dual China or the tri-China's notion that Tom and I have often talked about, that the very rich will always be importing luxury goods, and BMWs and Mercedes will be part of that story. But the bulk of the Chinese population is still struggling, and struggling even more so post-COVID and post the property market collapse. Unless the reforms are put in place to restore the confidence that Chinese people have in the property market as a store of wealth, we're not going to see the consumption burst sustained that we saw in the past. And I think that's something that the Western forecasters have not put in place yet.
Bill, China's leadership does not like being embarrassed. This week, a lot of people think they've been embarrassed. What do you think the consequences of that are?
Well, the balloon industry is going to get a deflating story, I think, ahead of going. But I think one of the things that the Xi Jinping has got to demonstrate is that he's got control over the government. And if you have a couple of stray renegades putting out foreign policy affecting moves like letting balloons go over the world and getting caught doing it, there's going to be some heads to roll.
Bill, let's unpack that just a little bit. The takeaway over the weekend is that none of this happens without the sign-off of the leader of the Communist Party. Are you suggesting that someone within the party did something on a rogue basis, went and did their own thing without his sign-off?
I think you overestimate the ability of the center to control the rest of the government. As you know, there's always some fool out there who's decided to be innovative or to embarrass the leadership because they're at the leading edge of the revolt against the party leadership. Either way, I think one of those stories will be acted upon. We've had scenarios before where the central leadership has been challenged by leaders like Bo Xilai, who was arrested for corruption and just taken out of the picture. What we will see here is, I think, a story that's going to evolve where the person or persons behind the balloon story will never know, and we'll never be heard of from again.
It's the rogue weatherman, Tom. It was the rogue weatherman.
It's serious
that went and
stuff.
did this.
This is serious stuff. We talked to Stavridis about this, Admiral Stavridis about this again. And to Billy's point, there's this, I'm as guilty of it as anybody else, juvenile idea that everything starts behind the red doors in Beijing. And to a person, Elizabeth Economy, William Lee, the rest of them, Jonathan Spence, have said, you're nuts. That's not the way it works.
Let me just thank Bill quickly. Bill, wonderful as always, sir. Bill Lee there.
You, Bill.
Of the Milken Institute. Lisa, just to build on that, there was a takeaway over the weekend. Nothing happens. To TK's point, nothing happens without Xi's sign-off. Was that the case this time?
Well, so it's sort of damned if you do, damned if you don't, right? If you didn't have control over this, then you don't have control over someone tinkering in their, in their garage and coming up with a balloon and then sending it over another country. And if you did sign off on it, what was the diplomatic purpose right ahead of what was supposed to be a Tony Blinken meeting that was supposed to be conciliatory? So it's sort of either way a very awkward moment from a messaging standpoint.
And Stavridis' book with Elliot Ackerman, which was my book of the summer a year or two summers ago. It's
with the other 10 books.
No, it's a phenomenal book. And the heart of it is Dr. Lee mentioned there, and this is not funny, these people just disappear. In Stavridis' fiction of 2034 in the back end of the book, people disappear and they don't look like Leonardo DiCaprio. I bust Stavridis' chop. He just wrote it to get a screenplay. Coming to Netflix,
I'm looking forward to that with your other book of the summer.
Well, I got 3 or 4 of them.
I'm aware.
What
was book of the year last year?
Linear Algebra, 4th edition. But I'm serious. This is not funny. I'm going to say it. I didn't say it. Dr. Lee said it. People disappear.
I know. It's dreadful. That's what happens under dictatorships, Tom.
Yeah.
It's no joke. Yeah. It is no joke. Greg Staples is coming up, 7:30 Eastern Time. We need to talk about this bond market. He joined us from DWS. Yields are climbing. Equities look challenged in the face of that. Equities are down about 0.6% on the S&P. On the Nasdaq, even lower. Look at that. Yields up through 370 on a 10-year now, higher by 5 basis points. Deutsche Bank. Did you see that, Bramo, this morning?
4.2%.
Yeah, over in the private bank. Hello, 420. On a 10-year, that's what they're looking for.
Bad 30-year auction yesterday. That's the reason why.
Soft?
Yeah.
You're looking at the supply?
I noticed it.
You didn't watch that one, Tom?
I was taking a surveillance snap and vet bill woke me up.
Slept
Look at
through
the 30-year.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Ukraine has stepped up its campaign for more weapons from the West this week. President Volodymyr Zelensky traveled to London, Paris and Brussels seeking help. And the country's deputy prime minister has told Bloomberg that time is running out.
More military assistance is needed, but the major thing is that we need it now. We do not have to have this 2 months time lag because it will be crucial for Ukraine's victory.
She also called on the EU to begin the process for Ukraine to become a member. The death toll from those earthquakes in Turkey and Syria has now risen to more than 22,000. Experts fear tens of thousands more people are buried under the rubble. Turkish President Erdogan is facing mounting criticism over the country's poor construction record. He has also been criticized for the government's response to those quakes. Apple is under less pressure than its tech peers to slash jobs during the current slowdown. That's because it did hire more efficiently in the first place. During the industry's hiring binge, Apple added fewer employees than other big tech firms. On top of that, the company generated far more revenue per new hire than its peers. Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg.
A massive pain trade. You've basically had almost no fund inflows this year. Your cash levels are 5-6%, depending on where you look. Short positions, very, very high. And that's been the sort of gasoline on the fire, if you like, of these sort of less bad fundamentals.
It's been a huge pain trade. That was Ben Laidler there weighing in on some of this over at eToro. If you think about that pain trade year to date where we have been, it's been pretty brutal for anyone that's been short. Let's put it that way. The S&P 500 is still higher on the year by about 6.3%, up by about 12 or 13% on the Nasdaq. You can take some more away from that this morning. Let's check out futures together. We're down about 6 or 0.7% on the S&P. You want to play the blame game? Take a look at Treasuries. Maybe yields up by 5 basis points through 370 again. Blame crude, rallying by 2%, just short of 80 on WTI, advancing on Brent as well as Russia pledges to cut output by 500,000 barrels a day. And reportedly OPEC isn't ready to step in and offset that. I'd say the earnings season so far wasn't great, and this market was pretty rewarding for the beats and for the misses. Didn't really punish that much. We had some numbers from Evercore this morning from Julian Emanuel. I can share them with you. He said the average stock price rose 0.5% post results. Companies beating on both the top and bottom line. They call that double beats. This is what they did. Higher by 1.4% on average versus 1% over the 5 years average. And the double misses meet on the top miss on the bottom and top line. They were lower by 1.4% on average over the last 5 years. That number's been 2.9.
Yeah,
so
it's a must-read.
So not really punished for the misses.
Exactly.
And rewarded for the beats.
And Julian now really weighing in now as the more numbers come in, as we'll talk to Gina in a moment. And the basic idea here is there's been a multiple expansion. No one guessed that.
Well, and that's exactly the part. I mean, I was also really entranced by this note because he talked about how at the same time that you've got earnings that are downgrades, essentially, you have rising multiples that now have resulted in the lowest equity risk premiums in more than 10 years, to just give you that point. Right
now, Gina Martin-Adams is going to join us, Chief Equity Strategist for Bloomberg Intelligence. And as we just did with Bill Lee on China, we're going to prepare you for a weekend of thinking about the fractious path forward. I'm going to go to the equity strategist, Gina, Stephen Colbert, and I'm going to look at the growthiness that's out there right now in value. You are cautious, you are value-based, and yet growth is winning right now. Give us the future growthiness that we can find in a value approach.
Well, I think that it has definitely been a confusing market so far this year. In January, we saw the unprofitable companies outperform profitable companies across markets by the single strongest month, one of the single strongest months in the last 20 years. So we absolutely are in a confusing market, but that's already starting to unwind. Through the month of February so far, we're starting to see value pick up a little bit of steam. Some of the big cap growth stocks are hanging on, and I think that's a reflection of the earnings season where they've been very, very good at managing investor expectations and also very good at hitting on the nerve of investors, which is margins. They've all announced cost cuts. To the degree that they announce cost cuts, they're rewarded for that, and that explains the price performance that you've been noting so far this morning. I think we're going to continue to see the market rationalize expectations over the course of February and probably into the spring months, and we'll see some of this froth come out of the market. But let's not be too attentive to what happened in January. It's a 1 month trend. Certainly unprofitable companies won't outperform profitable over the longer run. And we want to be a little bit more rational in our approach going into the rest of 2023 because there still is a lot of uncertainty out there.
Well, let's challenge that conclusion, Gina. Is that down to the bond market? What drives that view?
Yeah, I think it is mostly the bond market, frankly, John. When we look at the trend in the equity market, it's very clear that what took the wind out of the sails of this unprofitable trade, small cap trade, was very clearly the Fed meeting. And while right after the Fed meeting, the market has been kind of choppy, it's pretty clear that that was a peak point for optimism in the equity market. It's pretty clear that that has resulted in some rational movement in yields as well. You know, the equity market and the bond market have moved in close tandem since the equity market's low in October. The equity market does take a lot of solace from the bond market trend. If the bond yield is falling, the equity market is generally going to celebrate that as a signal that the Fed is going to ease policy. But I think, you know, as much as we criticize the Fed, they have been relatively successful in navigating this overall climate so far this year, especially since this meeting. You know, we criticize the Fed for not doing enough, but the reality is that they are doing something to take that sort of froth out of the equity market and the bond market alike, and are doing a relatively good job at managing expectations for their policy going forward. And they're very clear. Policy is not going to take any kind of reprieve until inflation is very clearly under some degree of control.
Well, Gina, there's a lot to unpack here, and to build on this idea of taking a signal from the bond market, do you think that equities have fully repriced the higher rate expectations since the labor market report last Friday that the bond market clearly has? I mean, you have seen a marked shift in Fed funds rates. Have stocks fully reflected that?
No, I don't think so. I think when you look at the equity market, there are a lot of underlying currents in the equity market, and it's incredibly important at this point in time to talk about the market and its underlying constituents, because the entire market, when you look at the equal weighted S&P 500, it's trading at just 16 times forward earnings. That's not tremendously unreasonable. It should probably be closer to 15 times, but this is, really getting nitpicky for the equity market. The problem in the equity market are the high duration stocks, because when you look at the entire equity market and you look at it on a market cap adjusted basis, it's trading more like 18 times forward earnings. This is still a concentration of risk in the tech, media, and telecom space, the large cap growth space, that is very vulnerable to interest rate rises. We've been in a period of time over the last year and a half, in which this space has been derating relative to the rest of the market. We've seen a lot of that bubble that developed in the pandemic deflate with rising interest rates, but it's not by any stretch of the imagination over. It takes a long period of time. And you've been in this period on a very short term where these companies have been extremely good, as I already mentioned, at managing investor expectations. So they've been able to create a degree of optimism through announced buybacks, cash deployment strategies, also cost cutting and layoffs to help enable investor confidence once again. So we're going to have a lot of give and take in this space as we see investor expectations sort of come out of this market, investors need to get a little bit more optimistic or a little bit more excited about other opportunities in the S&P 500. But this has been, a 10-year process of getting too overly exuberant on one segment of the market, and we're deflating that now. It's just going to take time.
This was great, Gina. As always, great summary of things. Gina Martin-Adams there of Bloomberg Intelligence on this equity market. This equity market near session lows, down 0.7%, really in response to what we're seeing take place in the bond market and both the commodity market alike. So futures a bit softer, Treasury softer too, yields are higher, crude's rallying. We talked about that 420 call from a little bit earlier from Deutsche Bank. In the private bank, Christian Knowlton, the Global Chief Investment Officer over there, looking for 420 on a 10-year. If we look at where we are right now, on a 10-year, on a 2-year, in America, and hopefully we can bring up those in a full screen maybe. We'll go through them together, 2s, 10s and 30s. Your 10-year right now up 5 basis points, Lisa, to 370. On a 2-year up 3 basis points to 451. We're picking up again. It's a challenge to the lows we saw in the last month or so.
And it feels like there's not the same kind of conviction in terms of coming in and buying when things get to a certain level. Things are passing through resistance. There's a bigger question around the business results, or the business consequences of money that costs something. And I go back to Lyft, and I wonder how much you see more consolidation, more rationalization in the biggest players at a time when money does cost something, and the risk of not investing enough is that much greater.
Gone are the days of chasing streaming subscribers over Disney Plus. Wasn't that part of this story?
Exactly. So then you start to see the layoffs and the parebacks, and this is a different environment.
To the growthiness there, and Gina was brilliant mentioning 16 times earnings, and that's this other market. I would note Apple models out pretty much consistently at a 25 earnings belief, and I just did the math off the MEMB screen on the Standard & Poor's 500. Lisa, I did not use the Dow Jones Industrial Average, and on the Standard & Poor's, it's 16.6%. Are the four? The 4 is 7, rounded up, 17%. Amazon, rounded up. Amazon will come back. 17% of the stocks of 500 are 4 stocks.
Yeah.
I mean, it's the weirdest time still.
Well, and how much does that continue to get consolidated simply because of the lack of free money? There also are these potholes, these interesting stories, and I wonder how much we would be talking about these even if money weren't free. And I'm thinking of, for example, Adidas and the $1.3 billion of Yeezys.
Adidas. That wasn't lost on me.
Yeah,
nice.
I'm trying. You say Adidas?
Adidas.
Well,
I don't really care.
One of our
think about anything.
We're here barely styling. One of our staff came in yesterday with like a 1970s Adidas jacket on.
Nice.
It was like,
So they've put a price on losing Yeezy.
Well, yeah, and it's big. And they have all these like shrink-wrapped Yeezys.
Yeasty?
Yeasty. Yeah, Yeasty's huge, Tom.
Yeah.
6 to 9 months from now, we're going to have put the term disinflation up on the shelf with the term transitory.
A lot of people are looking at 23 as very much a transition year.
You're looking at this data and you're saying the puzzle pieces are not fitting together.
We've got basically a 50-50 chance, we think, of a soft landing versus a mild recession.
We can probably skirt around a recession. If we have one, I don't think it'll be very bad, and I don't think it'll be very long, but my base case is we dodge it altogether.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Lisa calling it mission get to the weekend. Thanks for being with us, Lisa. We appreciate it.
It's good, Lisa.
Come on, you guys are going to throw me under the bus. We started at 6 a.m. by saying, let's try to make this productive.
Thanks for arriving and showing up. We appreciate it. Thank you. From New York City, good morning, good morning. With Lisa Abramowicz and Tom Keene, I'm Jonathan Ferro. Futures right now down 0.6%. We've got a rally in the commodity market, a sell-off in the Treasury market. Tom, your 2-year up 3 basis points, your 10-year up 4.
Bond gives me more today. You mentioned the German 2-year going out to a new high off that huge negative interest rate of months and months ago. But there is an adjustment here. The VIX out above 20, 21.77 up a stick on the VIX shows a little bit of the tension there. And I'm going to mention this, John. I don't think we brought this up. You've been remiss on this. Inflation on Wednesday, Valentine's Day, and the next day retail sales.
Just to make sure you get this right, because this is important. Tuesday is it? I
had no idea. Tuesday,
just in case you miss it.
Damn, I made the reservation.
Just in case you miss it. Just in case you miss it.
Like so many people are sending him stuff, he can't keep track of the days. You know.
Yeah, if you're just tuning in, apparently Tom receives loads of Valentine's Day gifts.
No, I don't
How many
get
have you
gifts.
received?
They send me emails that are teased by Mrs. Keene.
Like
we thought
poems.
you'd want to see this. We thought you'd want to see this item.
I don't want to know. I don't want to know. That sounds special. Let's go through the price action. Equity futures are negative. Yields are higher. Crude's rallying. Russia pledging to cut output by 500,000 barrels a day. That's the latest on the crude side of things. If you're wondering whether OPEC Plus is going to step back here, our reporting here at Bloomberg suggesting they won't. Lisa, right now, crude 79.74. We're up by 2%.
Which really goes back to what David Levovitz of JP Morgan said in that intro. Disinflation is the new transitory. And I want to just sit on that for 1 second before going through some of the events today. But how much does oil really shift that narrative of disinflation? If oil prices continue to push higher, and if you don't necessarily get this really push in economic momentum from China into Europe?
Going to keep pushing out the recession call as well, or bringing it forward off the back of that?
I don't know, because it's such a mushmash, and if I said that I knew, I would be lying. Let's talk about what the events are today, and other people are going to tell what they think is going to happen, who are more qualified than I. 10 a.m., we're going to hear from the 500 people that are polled for the U.S. University of Michigan Sentiment Survey for the month of February. I am curious to see whether it ticks up, and it really does reflect pretty directly where gasoline prices are, and they have been stabilizing. That said, you have seen the potential for a tick up in the year ahead expectation for inflation, because they do tend to give very accurate, to the 0.1% projections of inflation.
You're looking at me for a comment on new Mitch sentiment. I'm going
to give you a comment. There's like 5 or 6 data points. I've always been suspect of it, but McKee is right. You look out 5 to 10 years to see if inflation expectations are getting unanchored. The experts are saying no, they're not.
Based on the 600 people they called.
Well, maybe 522. There were. Yeah.
Chairman Powell cared about it.
And then he cared about it. Right. Okay. All right. We're also looking at the European Council, which has been meeting in Brussels. And yes, they're going to be talking about Ukraine, and there have been a number of developments on that front. We're also watching their response, what kind of collective effort they can make to counter the U.S. Inflation Reduction Act. And John, you've brought that up a lot. This could potentially be a real point of tension between the two allies and what that means. Also today, we do get a host of Fed speak, including Fed Governor Chris Waller, Philadelphia Fed President Patrick Harker. Are we going to learn anything from them? Maybe they'll just say the same thing.
Harker's usually, they're both really good.
They're both
different. They're different. These are not academic wonks. These are guys in the trenches doing legit research and legit business
This
operations.
is at a crypto conference, right, in Miami?
Well, there's one that's 12:30 and there's one at 2. I believe so. I will check.
Yeah, I wonder what they're going to talk about.
Yeah. Well, can I mention this as we get started on next week?
It's a crypto conference.
John, the Tuesday inflation report.
It was us. They're going to say that.
John, I want you to start large here. The chic gold Rosalie roses.
Oh, here we go.
They're preserved roses. Lisa, top ticks, $499. Delivered in a 16-inch cardboard. Yeah, it comes in a fancy gold vase with these preserved roses.
Oh, they like.
I thought we started large.
Like super long shelf life.
Yes, exactly.
So 500.
Yeah, 5 days.
$500.
$499. That's
how many do you get?
You it's an ample amount. It's more than a dozen.
It's for interior decorating. It's not for balance.
Yeah, it's like an interior decoration thing. But it's for someone that wants length here instead of what did John spent $189 last year and they died. They died by what, 10 a.m. the next morning?
If they could last another year, that'd be great. I'd put them away and then just bring it back out again.
Along with
That'd
the Christmas
be great.
tree.
No one would notice.
You can depreciate it on your taxes.
Thanks for that, Tom. That's a good idea. Barbara Reinhardt joining us now, the head of asset allocation at Voya Investment Management. Barbara, thanks for being with us. We appreciate it.
Thank you.
Are we pushing out that recession call?
We are. So we think that the fall in interest rates that you've seen since October of last year, 58 basis points on the 10-year Treasury, easing of financial conditions pushes out the recession call. We think that it's probably likely to be somewhere around mid-2024 rather than the second half of 2023. Part of it is that when a lot of people are looking for recessions, they don't tend to materialize.
What's so important here is you have the call that our listeners and viewers in America are comfortable with, which is stay in America and trust American multinationals. Why do you push against the international angle now? And what are U.S. multinationals? I'll use Apple as a China proxy, but there's many other names. How are those American multinationals going to react in the coming 3 years?
So let's take this in two parts. International developed equities, they tend to rally against the U.S. If you take a look over the past 15 years, there have been 4 times that there have been substantial outperformance of international versus the U.S. They tend to last on about anywhere between 3 to 6 months. The rally tends to be about 20%, and then it tends to give all of it back. It's not to say that that trend line can't be broken at some point, but it looks like it's starting to stall out. Since January 19th, the U.S. has been outperforming international developed markets, and we think that's probably the beginning of a reassertion of the U.S. outperformance. It's not a consensus call. There have been lots of fund flows going out to European equities, out to developed international, what we call EFA. We do believe that the U.S. probably has a better growth dynamic, in part because the Fed has been one of the earlier central banks to start tightening policy, which means it's also likely to be one of the earlier central banks on exiting their tight monetary policy as well.
So taking it a step further, are you pushing back against this idea that the rally in January was a fluke and has to be completely reversed? Are you actually seeing any sell-offs as an opportunity to buy more?
Well, the rally started actually in October. So the U.S. is up about 15% up off of its low. International developed markets are up about 27%. It was very oversold sentiment. You had sentiment indicators that we like to watch on a daily and weekly basis that were oversold for over 100 days. That's only happened 3 other times in our data series that we go back to the mid-1990s. So you have to appreciate that there was so much pessimism, so much bad news priced in, so much concern that it didn't take much in terms of a fundamental change at the margin for equities to be able to rally violently off of that. It can't continue forever. The easing in financial conditions, the easing that you've seen in bond yields certainly helps for a while, but you do have somewhat of a top on the equity market in terms of multiples. We're using these opportunities. We reallocated back into the U.S. We sold some of our bond positions after they had done extremely well, knowing that it's going to be a tougher slog from here. You can easily go up until we think probably halfway through this year. Part of it is because the inflation comparables, the year-over-year comps, are very easy. We see that probably starting to turn possibly after the June data, which is released in July. That's when the year-over-year comps on inflation, which is what everybody is worried about this year, become a bit more difficult. But between now and then, it's probably likely higher for equities.
She's way too optimistic. I mean,
Not one of Bramo's friends.
Yeah,
I actually think this is fascinating.
Oh, do you?
I actually really enjoy this greatly, and I think
what as a bear you enjoy this.
As someone who is skeptical of groupthink, there's so much groupthink now that there's actually going to be some big fall that I kind of like that it's pushing against that. I like the counter consensus. I appreciate that.
Appreciate that. I appreciate this from Michael Hartnett this morning of Bank of America. You're going to love this, Tom. This is great. An English strategist moved back to London with a wife from New York. After 3 years, someone asked the wife, "What's the best thing about living in London?" The wife replied, "Paris." And what's the best thing about stocks in 2023? Bonds. Isn't that great? The best thing about 23 about stocks is bonds. And he puts out this chart. I think Michael Hartnett's just tremendous. Michael, why don't you come on this show? I don't know. Anyway, puts out this chart. Best start to the year for 60-40 portfolios since 1991.
Yeah.
Is that going to continue?
Well, it's coming off of an absolutely horrible year, of course, right? So there's likely to be some mean reversion. The problem that you have in the bond market is you still have the Fed acting somewhat aggressively, even though they've had somewhat of a more data dependence. It seems to us as though they're convinced to raise rates at least 2 more times over the course of this year. The bond market is pricing in a big slowdown in growth, but I would say that the inversion on the Treasury curve, while it's a fantastic predictor for recessions, it has a very long lead time on doing so, anywhere between 8 months and 24 months. You've been inverted on the Treasury curve for about 8 months at this point. I don't think that you're going to have a big buying opportunity for bonds probably until you're past some of the uneasy or unfavorable comps in inflation, which probably go through October.
So you think it gets tricky around the summer, around July time when you get the June print. David Leibovitz, at the start of this hour, in that highlight reel we put out over at JP Morgan, what did he say? He said that disinflation would go on the shelf with transitory.
Correct. Disinflation is the new transitory.
Do you agree with that?
Yeah, look, I mean, there certainly is a case to be made that a lot of the inflation that you had was transitory after all. Unfortunately, Fed Chairman Powell didn't tell us how long transitory meant. But you've had, a 15-month upleg in inflation. It's unlikely to be able to sustainable at this high as growth is continuing to slow.
We love your thoughts, but the reason we had you on is Voya is with ING of the Netherlands. Mm-hmm. Can you get us tickets to the Vermeer show?
No.
That's why we...
It's impossible.
John, they have sold 200,000 pre-sale tickets to the show of a lifetime in Amsterdam.
How much are these tickets?
I think they're reasonable.
Yeah,
I don't think they're like a gouge.
They're something like 38 euros. It's not terribly expensive.
Which is the reason why you can't get them.
200,000 pre-show tickets to an art show of Vermeer.
They had a Vermeer exhibit at the Met, and it was amazing.
Talk about something that's rare. I mean, there's only less than 40 Vermeers in the world.
Yeah,
so
but
you should get your eyes on them. Get to it.
Buy art, is that right?
Yes.
No, I'm not advocating any art. That's not my asset allocation.
Reinhardt, visit Chelsea.
Oh, dear.
Barbara, this was great. Thank you.
Thank you so much for having
Thoroughly
me.
enjoyed it. Thank you. Barbara Reinhardt there, of Voya Investment Management. Live from New York, futures lower. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. A surprise at the Bank of Japan. Bloomberg's learned that Prime Minister Fumio Kishida will nominate Kazuo Uedea to take over the central bank in April. That led to a jump in the yen. He is a professor and a former BOJ board member. Uedea has expressed concern over raising interest rates prematurely. Reportedly, Deputy BOJ Governor Masayoshi Amamiya refused to take that job. In Turkey, 3 survivors were pulled from the rubble today, more than 100 hours after they were trapped by the killer earthquakes. Rescuers had worked for more than 3 straight days. Meanwhile, the death toll in Turkey and Syria has now climbed to 22,000. Russia has launched a number of cruise missile attacks on Ukraine today. Ukraine says the targets were critical infrastructure in several cities. Meanwhile, Germany's Chancellor Olaf Scholz has asked European leaders to deliver German-made tanks to Ukraine. As promised, the goal is to have 80 of those Leopard 2 tanks there by the end of March. Russia is retaliating. Moscow plans to cut Russian oil by March production by 500,000 barrels a day, and that's in response to price caps imposed by the West. That is equivalent to about a 5% of January's output. The news sent crude oil prices higher. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg.
We're benefiting from a shift of consumer spend from retail, buying stuff when you're home, to actually spend on services. When we look at inflation, about 70% of our drivers are saying that inflation is playing a factor in terms of their coming to earn money on the Uber platform. So in some ways, inflation may be a tailwind to our supply. Our performance has been really robust, and we think it will continue to be robust.
That was Dara Khosrowshahi there, the Uber CEO. Uber, the big winner this week. Lyft, the big loser. We'll get to that in just a moment. Equity futures right now down 0.6% on the S&P. Yields are higher right the way through this curve. 2s out to 30s. Your 2-year up 3 basis points. Your 10-year up 4. If you're looking at crude, a rally by more than 2% on WTI, just short of 80, 79.67 on WTI. The latest from the Russians is that we're hearing they want to cut output by 500,000 barrels a day next month. The latest from OPEC Plus, according to our reporting here at Bloomberg, delegates associated with that cartel saying they won't offset the cuts, Tom, and ultimately that's behind this move. Mohammed Al-Arian writes in, he's not alone. A lot of people have written in saying, thank you for reminding us, Tom, that it was Tuesday and not Wednesday for Valentine's Day.
Yeah, it's been a huge response.
So he led with a thank you, Mohammed, anytime. Yeah. And then he told us to look at this, and I'm looking at it right now. Just published this week in Project Syndicate, Tom. Yeah. There is more inflation complexity ahead. Lead paragraph, as US inflation gradually eases, the claim that today's inflationary pressures are the result of a temporary supply shock has re-emerged. He goes on to say, while this thesis may be comforting, it could also encourage dangerous complacency, making an already serious problem much harder, Tom, to solve.
Oh, it's a transitory idea here. Dr. Al-Arian really right up top in the Project Syndicate article really mentions transitory is back in some way. I think that's a nice way of putting it. It's not the same as the fever that we had, a year and a half ago, but it's out there. I thought Michael Darter was really, really elegant on this. And what's interesting is you mentioned Torsten Slok at Apollo out with a note this morning on the 10 reasons why inflation could be a bit of a challenge to get down to that transitory outcome.
He's really led with this idea that maybe it's not a hard landing, it's not a soft landing, it's no landing at all. Well, and I pinged Torsten a message just moments ago and said, Torsten, is that now your base case, a no landing? And he said, yeah. He said this, inflation's going to be sticky, the Fed has more work to do, and more demand destruction is needed. That's the base case now of Torsten Slok at Apollo.
So this is what I was thinking about last night. Is a no landing necessarily wonderful for risk assets, or is it not, right? Or is it basically a transfer of some of the asset price inflation to an economy and really transferring some of the strength of the economy rather than just see the asset price inflation? Because you will see margin compressions and you will see some of the response in the corporate community that might not lift stocks to the same degree.
We don't have the time now to go into that, but it's a really important theory you're bringing up. What I would suggest, John, is this view, this stew, this toxic brew on Friday. And folks, it is Toxic Brew Friday. The answer is it supports nominal GDP, which keeps these companies going.
You'd have to think. Can I give you the cheat answer? Maybe.
Please.
I don't know what happens in absolute terms with equities, but you'd have to think in relative terms tech would really underperform, facing the prospect of higher interest rates from here.
Well, that's exactly it. And a lot of the unprofitable companies that did the best to start the year would actually struggle in this environment. So again, I don't know what a no landing would mean for risk asset performance. It might not be such a clean, direct link from one to the other.
Bad news for Lyft. Let's put it that way, right? Companies like that. It's getting hammered this morning, Tom, that stock.
Yeah, I don't know what the percent point is. We'll get it up here in a moment. Mandeep Singh joins us now. He's been so generous to join us here as he writes up the Uber-Lyft divide. Mandeep, I've never seen the divide so great. What's the timeline of Lyft to survive if they're going to compete against a successful Uber?
Well, so look, right now they are burning cash. And even in the guidance last night, it was fairly obvious that insurance is becoming a big problem for them. And we didn't hear that from Uber. And I think that just goes to show that being a smaller player in this market, whenever you're running a marketplace, it's a big disadvantage. And I think we heard it from Lyft that they're having issues with supply. Insurance, spreading that over their, subscriber base, which is 20 million compared to Uber, which is north of 130 million. And those are the sort of things that come into play in terms of, how long can this go on. But time will tell in terms of, just in terms of how much growth headwind they're going to see.
Mandy, question came up 3 times this morning. Can Lyft be taken out by Uber? Or is there a regulatory issue here where we need a duopoly?
Yeah, I think it's unlikely that Uber will buy Lyft, given Uber has themselves made quite a few acquisitions. In fact, I never understood why they bought this company, Transplace, to expand in freight. Uber's multiple would have been much higher if they didn't have that diversification, especially freight that has no synergy with their core ride-sharing and delivery business. But I think in the case of Lyft, they would need some B2B partnership or something on the delivery side or logistics side, last mile delivery, where it increases the trip frequency and volume, because that is where they're struggling. They can't maintain the supply if they don't have the frequency. And right now, their frequency is going way below Uber in terms of the network usage.
So it's difficult for them to cut prices to growth, right? That's basically the takeaway there. What about the lack of investment opportunities for Lyft at a time when they have much less cash flow to play with than Uber?
Yeah, look, I think they can't even think of expanding outside the U.S. or in new geographies or in new categories like delivery. So that time has passed. Now it's about, how can you show that, this business can generate free cash flow? And we're seeing they're struggling because this insurance element came out of nowhere. Now it became like a $350 million drag on the free cash flow last quarter, and it will continue to be the case. So clearly there is an aspect of variable costs going higher for these kind of businesses. You don't have a large subscriber base and you don't have the trip frequency to manage that. And over time, I think Uber may start doing a lot of the insurance themselves. That could help bring down the cost. But if you're a small player, it becomes a big challenge to maintain all these aspects when you're running a marketplace.
Hey, Mandeep, this was great. And you've been phenomenal this week on both Uber and Lyft. So thank you for that. Making us all smarter. Mandeep Singh there of Bloomberg Intelligence. Can we just bring up the stock again of Lyft in the pre-market, getting absolutely hammered? And I just want to frame it in, I think, in a more appropriate way. Yes, it's down about 30%, 32% today. So we're at 11 in the pre-market, okay? We ended 2022, guess where? 11. That's where we ended it. So you've had this massive rally year today, up by 47%. And now we've just taken out all the gains. Just taken out all the gains in the pre-market this morning.
Well, it gives you a sense, too, of how limited a potential bounce back could be. I mean, to talk about the bounce back, Lyft shares were down by 74% in 2022. So this might have been, okay, well, maybe we overestimated how much the decline was. And then it's like, wait a second, not necessarily. That seems to be what's going on in the market.
Well, we've had this massive pain trade, haven't we? Yeah. All this short covering, boom. We've seen these massive rallies in single names and at the index level as well in the NASDAQ. And then you get this kind of fundamental pushback from the earnings story. And this is what Mislav Matejka was talking about at JP Morgan. He was saying this is all about positioning, this is all about flows, it's all about short covering. Are we going to get that fundamental clarification for the next leg higher, the validation? And he just doesn't think we're going to get it more broadly.
Which really is, you explained this really well about people playing in options with the cash that was being thrown off from
Well, that was Julian Emanuel of Evercore, yeah.
But to me, I mean, you just wonder how much this froth gets perpetuated by higher rates, not necessarily dampened on the margins before there's some sort of bigger economic consequence.
It's okay, something to watch.
Yeah, and within all that is the corporate battle here of corporations adjusting. And, I think we way underreport the size of the big banks in America. These things are giant that we talk about every day. And I don't think we talk enough about the separation of Uber and Lyft. You got a run rate off the Bloomberg screen on Uber of 31 billion. You got a run rate of Lyft of 4 billion. And yet we talk Uber, Lyft.
Totally.
It's just, these are things that have to be said.
But Tom, don't you think that's a domestic bias? Because Uber's international, but here in the United States, we're used to both. The rest of the world isn't. And doesn't that speak to the difference in the numbers?
Precisely, and you feel that personally in a place like Paris where it's Uber and they can't, the visceral hatred of Uber in Paris is tangible.
Let me guess, we should do some ground research.
Totally, in Paris.
To see
well, I don't know. I mean,
100%.
I don't know how they do it in London because London has the best cab service I've ever seen, except every single cab driver's for Arsenal. I've noticed that.
Have you noticed that?
Yeah.
I meet a lot of West Ham fans as well. For those of you that have written in the last 20 minutes or so, I did not say the best thing about London was Paris. I was quoting someone else. Okay? The best thing about Paris is London. Let's put it that way.
You think that's going to get you out of the hot seat?
It wasn't me. Equity futures down 0.6 from New York. This is Bloomberg. Equities down in response to higher yields. This is the picture for you on the S&P. Live from New York, this is Bloomberg Surveillance. We're down 0.5% on the S&P 500, down almost 1 full percentage point on the NASDAQ 100, just nibbling away at the year-to-date gain. Helped out by this move in the bond market, yields higher, 2s out to 30s, up by 3 basis points on a 2-year, back through 450, 451 on a 2-year yield. Think about where we were last Friday morning. where we were about 40 basis points lower on a US 2 year. It's been quite a move. A move in crude as well. WTI very close to 80, 79 to 74, up by 2%. Brent crude through 86 off the back of this announcement from Russia that they're going to be ready to cut output by 500,000 barrels a day from next month. And I think the important response that we've seen this morning, Lisa, which really speaks to the rally, not just today, but perhaps through this week as well, is that OPEC Plus won't respond and offset it.
Right.
That's important news.
That they might actually encourage the lack of supply, either because they see a dearth of demand that perhaps nobody else sees, or because they'd like prices to be a little bit higher. And deciphering the difference will really really affect the market and where it places this.
Been a lot higher this week, up more than 8% over the week so far. And I think Julian Lee also pointed to the events in Turkey, the tragic events in Turkey, may be disrupting some of the oil supply as well.
It's been a horrible story, I've got to be honest. It's just dreadful, and you just wonder why the buildings weren't better structured. I just don't understand.
I look at the aftershocks every morning, and this is the first time I can say it was almost a quiet evening from that northeastern Mediterranean up the broader valley. There was like 5 aftershocks, and they were all under 5.
It's been a shock for everyone who's seen this play out, and our thoughts, of course, with the people in Turkey and everyone affected by it. Just difficult scenes.
Just horrible, and we will keep tracking it. Do you want to just give you a sense, we were talking about Lyft and Uber, just to give you a sense of where we've come and where we're going. The divergence between the two names have been widening dramatically. Today you can see in the pre-market that Lyft shares, as we've been talking about, down 32%. Uber shares down 3.2%, so much lesser. But take a look year to date at what they have done. And just to give you some perspective, Lyft is down last year 74%, and Uber was down 41%. So already Lyft was underperforming dramatically. Year to date, Lyft is up 47%. Today's decline, as John pointed out, takes out most of that. Uber shares up 43%. So after today's trading, if the prices do hold, John, you're going to end up with Lyft almost flat on the year, maybe up 10%. Okay, that's marginal based on how much they've been fluctuating. Uber still will retain a 40% gain so far this year. So that gap really widening.
The winner takes it all.
That's the theory.
What did Mandeep say earlier this week? You Uber, you don't Lyft.
Yeah.
And we've been trying to figure out all week. Do you Google or do you Bing? Most people Google. Are they going to make us Bing? I think Tom was a showstopper yesterday. You and me, we're going to start using Bing.
People use Bing more than they think. There's stealth Bing usage.
What, they don't realise they're using
stealth
Bing?
Bing.
Yes, it's true.
Stop, pause. How do you use Bing more than you realise? Go.
Okay, because on your personal computers, that is the default setting that comes up for search on a lot of the Microsoft computers, the personal computers. So people end up using Bing and they don't realize they're Binging.
Oh, okay.
Learn something
I
every
thought
day on this
I just
show.
thought on the desktop you just opened Google Chrome and off you went.
Well, that's what people do, but sometimes they get stuck in Bing. And
They get
anyway,
stuck in Bing.
Yeah, let's move
Thanks for
on.
that.
Greg Staples is
You've
saying
really read into
save
this,
me.
haven't you? I think that's great. Isn't that great? Just a font of knowledge, as you might say, Tom. More Fed speak on tap today. Lisa's run you through that. We'll hear from Governor Waller and President Harker. Richmond Fed President Thomas Barkin had this to say, adding to the recent hawkish comments, quote, "It shouldn't be a surprise that inflation, while likely past its peak, is still elevated. That, of course, is what makes the case for us to stay the course." Mike McKee and I are going to catch up with Barkin next Tuesday, Tom.
I did not know that.
An
Very
hour
good.
after the CPI
Wonderful.
report. So we'll get you some fresh Fed speak post-CPI live on Bloomberg TV.
And into retail sales the following day, which I believe is a Wednesday.
Is that right?
Yeah, I'm hearing about that.
Are you moving the reservation
hearing
from
about
Wednesday
that
to
right
Tuesday?
now. Gregory
Okay.
Staples joins us now, head of fixed income North America at DWS Group, and with a very trenchant note that takes us back to a previous speaker, John Williams. You say this R-star discussion has serious merit, and you really extend out your view because of the neutral rate mystery that we have in 2023.
That's right, Tom. And I'll tell you, it seems like a lot of the dialogue right now is really over whether the peak rate in the next 6 months is 480 to 505 and so forth. And I'm not sure it matters that much whether they do one hike or two hikes. I think the Fed is pushing back against an amplitude higher than that. I think what they're really trying to emphasize in the Fed speak that we're hearing, we heard it from Williams this week, we heard it from Waller, is they want to emphasize the duration of it, not interest rate sensitivity, but how long they're going to stay at that peak rate, whatever number it is. They're pushing back hard against the concept of a pivot, the idea that they're going to have to ease in July or August, and I think they want to make that true, and I think that's what the market's listening to right now, and that's why you're seeing 2 years at 4.5%.
Long term for the financial media is maybe 3 months. What you're suggesting is you've got to extend out your view away from the consensus call. What does DWS suggest you do if you're extending out the Fed dynamics?
Very much our clients are long-term investors. We're not looking for the next tick in the 10-year. And so what we're looking at is not what we call terminal peak. We're looking at terminal floor. Where are we in the end of 2024? What level does the Fed get down to and stop?
What level is that?
Well, it was 3. The market was talking about through 3% as recently as a week ago, and with the unemployment number now, they've pushed that up maybe to 3.25. We think it's actually probably more like 3.5, and then you layer in a 75 basis point 2s, 10s, and you're talking about a 10-year that's appropriately more 4.25.
Okay, well, that's exactly where I wanted to go, because this is really one of the biggest shifts that I've seen in the past couple of weeks. Every guest coming on and saying duration's been overbid, and perhaps you want to fade that a little bit, and you're seeing that on the margins. We've got Deutsche Bank on the private bank side coming out with a 4.2% 10-year yield on that Treasury. You think it's the same. What's the path to get there? Is it sudden or is it gradual?
I think it's gradual. I think a lot of it is actually really if you're a leveraged 10-year player and you're buying the current 10-year, it was 450, now 470, and you're going to be financing that at the SOFR rate, which is going to be 480 after the March meeting. That's negative carry for a persistent period of time. You can do that if you believe that the 10-year rate is going to go down very quickly and you can get that negative carry back in price appreciation. But if you're looking at several months of holding on to that negative carry instrument, it only makes sense if you see the 10-year moving up to 4% at a minimum.
What does that mean for riskier credit? What does that mean for safer credit? What does that mean for all of these instruments that have been priced off some sort of stability in yields that might not be so stable?
Well, from one perspective, at least, we're seeing volatility come in a lot. The 2022 10-year range was 270 basis points. In 2023, we think it's probably more like 75. I think 3.25% to 4% is the range. So volatility coming down has always been supportive of risk assets. That being said, we've had a very strong rally in January, probably gone a little bit too far, coming from two things. I think it's portfolio managers were underpositioned in risk at year end. Plus, we're seeing more economic strength than we expected. The market was expecting a recession to start as soon as January, and it's clear the data's coming in and saying, no, we're actually having a pretty decent January.
There's a philosophical question, though, when you start talking about a terminal rate around 3.5% for a prolonged period of time, of the fate of companies that grew up in an era of free money. And rationalization around their business model at a time when people still expect default rates to remain so low. Do you think that people are underestimating the level of defaults, not necessarily later this year, but next year, the year after, if interest rates remain at the place where you expect them to be?
I'm not sure an additional 100 to 200 basis points is really going to crush some business models. Remember, this is the way things were for much of history until we got to the great financial crisis of 2009, 2010. Overall, we're actually still pretty sanguine around credit, and that's one of the reasons why we think the economy's done so well so far. Corporate balance sheets still have some decent cash. Any treasurer who didn't foresee this recession ought to be taken out and shot because it's been so well advanced. I mean, seriously, we've been talking recession for, 6 months now? And if you haven't battened down the hatches, you should be out of your job, quite frankly.
Let's not take it that far, Greg.
But yes, I
tend to exaggerate.
Let's rip up the script right now because Mr. Staples, with his decades of experience...
Do they teach you about the firing squad in the
Yeah, they do. Yeah. I've been there. But this is really important, and I allude to this when I ask guys like you about issuance. What's the lemmings over the cliff attitude now of CFOs in a meeting, and they've got to restructure either heavily debted, lightly indebted, forget about Warner Brothers Discovery, which is a train wreck. What do CFOs do here as lemmings over the cliff right now?
I'll tell you what, right now, the window is still open for issuance. I know prices are still high.
Exactly.
But they should be taking advantage of the market right now. The high-yield market, we did $8 billion this week of issuance. That was a market that was shut down.
I think our audience doesn't understand this, and the idea is the stuff is actually issued out. What's the dynamic now on issuance of credit dynamic and duration dynamic?
There's an incredible bid. Retail money is flowing into high yield. Institutional money is flowing into high yield. Again, I think it's a repositioning from being way short at year end, but that window can shut fairly quickly.
It was a buyer's market and no one wanted to sell. They're selling now. Are you seeing the leverage start to move? Just in terms of who's got the leverage, the buyers or the sellers right
now? Absolutely. We're seeing, obviously, deals come priced 20, 30 basis points through initial price talk, allocated at 15 or 20%, and then they're breaking 5 or 10 tighter at the break. This is a credit market that's almost a little bit frothy.
Wow. That's a massive change in the last month or so.
Huge.
So when we started this year and everyone said, let's go, let's get ready, juicy yields, where are we a month later? Same story, or has it changed much?
Well, I think people are still looking for 5% yields in the investment grade space, obviously more like 7 or 8 in high yield. So there's still a bid for it, but you were the people who raised lemmings. I think you could completely do a 180-degree turn if you see an S&P go down 5 or 10%.
Do you think this speaks to the rate cut story, that people see this as a once in a generation opportunity to get 5 and just hold on to it for a number of years? Does it speak to that? They just don't think this high rate regime is going to last.
I think for a lot of investors that's true. And I think actually 5% longer term is a pretty good yield. It disappeared probably 2 weeks ago. Now it's coming back with the backup in the 10-year. But it looks pretty attractive long term. I have to think that's true.
Fascinating. Greg Staples, thank you, of DWS Group. Just bringing the bond market alive, Tom.
Thought of this a couple days ago to issuance here. Debt, Apple, 5.1%. Microsoft, 4.2%. Some people would say to a CFO that's irresponsible. You know, Zvi Bodie, Boston University, Fabosi, that's just irresponsible.
Yeah.
I mean, there's just no other way. You know, when are we going to start seeing gajillion-dollar debt issuances here?
Oh, seriously?
Yeah.
I saw Intel this week, 11 billion. Sorry to interrupt, but yeah.
No, it's okay. You can interrupt any time. It's a better conversation than what I'm doing.
We'll just carry on. Nick Medenborough's coming next. You can weigh in. International economist at Wells Fargo. Looking forward to that conversation. Bramo, I think it's really important. Are we starting to see that leverage turn away from it being a buyer's market and back to it being a seller's market?
Exactly. And when you take a look at some of the issuers, I mean, you're going back to the lower-rated consumer-facing industries, Wynn, some of the cruise liners. You know, it raises this question: how much are people levering up the idea, as you put so well, that we're just going to go back to the same low-rate environment we once had?
More still to come. From New York City this morning, where's the markets? Equity futures, negative 0.6%. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Ukraine has stepped up its campaign for more weapons from the West this week. President Volodymyr Zelensky traveled to London, Paris and Brussels seeking help. And the country's deputy prime minister has told Bloomberg that time is running out.
More military assistance is needed, but the major thing is that we need it now. We do not have to have this 2 months time lag because it will be crucial for Ukraine's victory.
She also called on the EU to begin the process for Ukraine to become a member. Now the death toll from those earthquakes in Turkey and Syria has now risen to more than 22,000. Experts fear tens of thousands more people are buried under the rubble. Turkish President Erdogan is facing mounting criticism over the country's poor construction record. He has also been criticized for the government's response to the quakes. The special counsel investigating Donald Trump and his allies has subpoenaed former Vice President Mike Pence. Former National Security Advisor Robert O'Brien has also been subpoenaed. The special counsel is investigating efforts to overturn the 2020 election. The probe is also looking at the discovery of classified documents at the Trump estate in Florida. The UK avoided a recession last year by the narrowest of margins. Gross domestic product was unchanged in the fourth quarter following a revised 0.2% decline in the previous 3 months. The cost of living crisis and the strikes did hit the British economy back in December. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg.
China really needs to come to the table, and China's lack of willingness to comprehensively participate and to move in a timely way has really been a roadblock. China really needs to come to the table, and China's lack of willingness to comprehensively participate and to move in a timely way has really been a roadblock.
That's pretty punchy stuff for Janet Yellen, I've got to say, the US Treasury Secretary on China. Live from New York, here's the price action if you're just tuning in, counting it down to the opening bell, about 1 hour and 44 minutes away. Equity futures negative 0.6%, a softer week, heading towards the biggest weekly loss on the S&P 500 of the year so far. The year is young, I know, but we've had quite a rally to start 2023. Yields were heading lower, and now they're rebounding by 4 basis points. Your 10-year pushing 370. Your 2-year last week was pushing 399. Didn't get there, just short of it. Still above 4%, but this time through 450. That's a big change we need to get used to. Another change potentially going forward, less Russian crude. They're looking to cut output by 500,000 barrels a day. Crude is rallying, close to 80, Tom, 79.70, up 2% this morning.
Story of the weekend, John, it really, really matters with Bitcoin going 23,000 down to 21,000 handles. Bitcoin trades all weekend. And I really wonder what's going to happen here off of this Crick, and I hope I'm pronouncing that correctly, Kraken news, and the trenchant idea here. And John, you forced me to watch the World Cup, and I'm looking at it around at the banners are flipping up and down in the banners.
Yeah.
And it says Crypto.com was supporting the World Cup. So I looked it up, and right on their website, they're saying you too can make 8.6%.
My goodness.
The FT today on the Kraken mop-up of the last 24 hours has a branding that goes out to 21% return. That's what this is about, and Gensler's finally acting, to be clear, only for American owners.
You know what you might not see in the Super Bowl on Sunday in the commercial breaks? I think you probably won't see. In fact, reportedly, you will not see what we saw last year.
Yeah.
Which is just crypto commercial
Bitcoin-a-thon.
after crypto commercial.
Yeah.
What happened to all those celebrities? What happened to, what was it? Was it Matt Damon? It was like,
there's a whole bunch of them.
Brave.
Yeah.
What happened to those guys?
Didn't Kim Kardashian get fined by the SEC
She did,
for
yes.
some advertisements of some of the linked coins? There's obviously been a big disinflation with respect to crypto assets.
Well, it's there, but Ken Rogoff, who was the bravest guy, I mean, he got death threats off his book, The Curse of Cash, and he said to me a year ago, he said, when does Gensler go? And the answer's now.
You know what I see a lot of now in America? Sports betting. So many commercials on sports
We're amateurs at it compared to you guys.
Well,
you guys are relaxed about it.
I grew up with it.
Yeah, you grew up. Well, explain.
You just got used
Do you
to
bet
it.
on the Super Bowl?
I don't bet on the Super Bowl. I'm not into sports betting, but there was a betting office on every single corner. In fact, there was probably 4. I remember when the government tried to do something about it. There were these high-frequency machines you could play. Do you know the fruit machines?
Yeah.
Okay, so they wanted to limit how many fruit machines were in each store because they thought it was problematic. So do you know what the betting firms did? This is going years back, and they've addressed it since. But what the betting firms did was just open another store around the corner so they could get more.
I just remember
more machines in.
I
mean,
once went to
nuts.
an OTB, and I was actually pregnant at the time, and someone just pushed me down to get to the window faster, and it just sort of highlighted the whole experience.
Yeah, I'm just not into it at all.
Anyway, that was the last time that I went to an OTB. That's my contribution.
So you're done with gambling. Good for you. Are
You
we
guys done?
We're done.
Okay, that was great.
That was the Super Bowl segment.
That was the Super Bowl segment. That's as good as we got. Steve Bagliuca to be with us here for a substantial time in the 8 o'clock hour. Really looking forward to talking to the owner of the Boston Celtics, rumored to be with a interest with the soccer team in England as well. Right now, Nick Benenbrook joins us now. He's international economist at Wells Fargo, but far more is awarded and acclaimed in foreign exchange. Nick, let me start with that one, dovetailing your international economics to your currency expertise. What does the dollar signal right now?
Well, I think we're seeing a last hurrah in terms of some of these interest rate increases. You mentioned the yields in the United States going up, for example, and actually internationally this week, we've seen a whole bunch of rate increases. Australia, Sweden, Mexico surprised yesterday. So I think we're seeing a last little bit of hawkishness, which is just helping the dollar for right now. But we really think that's pretty close. And as we go forward the rest of this year and into 2024, US recession, eventual Federal Reserve rate cuts, we do think the dollar's actually going to revert to a softer trend at some point.
Hey, Nick, that's interesting because a lot of people are starting to talk about, or at least think about, the risk of higher DM terminal rates. Are you pushing back against that?
I think so. I mean, I really, and we're quibbling over quarter of a point here. But I still think, when you look at, say, supply delivery times, commodities prices, slowing growth, I don't think many of these central banks are that far away. So Federal Reserve, I think the debate is between, let's say, 5.25 maybe 5.5%, but very unlikely. It's probably between 5% and 5.25%. We're really very close.
So in other words, you're pushing back on this idea that we're going to end up with a stickier and higher inflation for longer, and that rates are not going to go down to the levels that they used to be, or at least to 2% in line with the inflation target. Is that correct?
Well, I don't know if I'm pushing back a little bit against it. I do think the peak of inflation is clearly in. We saw that, last year, and a lot of countries were actually starting to see core inflation come down. So I certainly think we're not going to see any further rate increases. And for sure, I think if you were to look at the Federal Reserve, we do believe they're going to, say, for example, ease maybe late this year, maybe early next year. But we do think they'll be easing ahead of the European Central Bank. And once they do go, we think they'll be moving aggressively. The higher they go, the harder they fall. So the Fed, they moved up, to above 5 to 5.25, we think. When they actually start cutting, we think they'll be moving down pretty rapidly as well.
David Leibovitz on this show of JP Morgan came out and said that disinflation is the new transitory. It seems like you disagree. You think that this is something more persistent and has longer legs. What if the Fed is wrong? What is the case that could potentially cause you to change your view? If the Fed is wrong, then I think we'll still probably, that could see the dollar move a little bit higher, or maybe the dollar's depreciation would be relatively slow. It is a case of, I do think the direction's fairly clear though. Indeed, one of the things we're seeing, I think, is lower inflation, and actually one of the things that we were concerned about last year was global growth, falling into recession. Our global growth forecast for 2023 has improved to 2.0%. It's still not great, but it's a lot better than the 1.6% that I mentioned to you last time, and it was very downbeat. So I think, if inflation doesn't fall as quickly, yes, we could see the dollar not go down as quickly, but I'm still in the, it's a dangerous word, but I'm still in the idea that this is relatively temporary. I wouldn't call it transitory. And certainly by the end of 2023, we should see inflation rates a whole lot lower, and that should be comfortable enough for most central banks, or some central banks at least, to be lowering interest rates.
Nick, we have been Lagarde-free today, and yet we see a German 2-year moving out to a new high yield. How many degrees of freedom is she losing on a daily basis as she has the choices to move forward into April, May, and June? How constrained is the ECB?
Well, I think they have some flexibility. The interesting thing about their last announcement was that they were fairly determined in saying we're moving 50 in March and we're going to keep on going until this inflation's under control. And I think the financial markets weren't that impressed. We didn't really see a rise in the euro that day, nor did we see on that day, at least, a significant rise in bond yields. I don't believe German bond yields. So, I think overall, if we're seeing a rise in German bond yields, that I don't think that'd be particularly worrisome to ECB President Lagarde. And again, with respect to that, I know we're talking about being close to a peak. The argument there, or the debate there, is probably whether they go 325 or whether they get to 350. And I don't think they'd be that upset if they had to, move another or wanted to move another 25 basis points, and that was consistent with market pricing.
Nick, my guess is it just built on the stuff we heard from Chairman Powell the day before, when Chairman Powell said the disinflationary process had started. Then straight out of the gate, President Lagarde said that the risks around inflation had become more balanced, not balanced, but more balanced. Would you agree with the assessment from President Lagarde of the ECB on the inflation backdrop?
I would, to some extent. It's probably balanced, and for a whole long period of time, they were talking about inflation risk always being to the upside. They must be pleased, I think, with the headline inflation in the Eurozone coming down to 8.5%. Again, I think the one thing that is probably concerning European central bankers, and why they're probably not that worried about bond yields rising in Germany, for example, is that if you look at the core rate of inflation and you seasonally adjust it, and you look at it over the last 3 months or 6 months, you're still looking at an annualized rate of inflation in core inflation in between 5 or 6%. So they're not really seeing a reduction in core pressures at this point, which is why I think they're comfortable going to 3.25, 3.5.
Hey, Nick, great to catch up on the ECB, on the Fed, on inflation in both regions. Nick Benenbrook there of Wells Fargo. The Italian 10-year yields rising today by 8 or 9 basis points to 420, but 420, I guess, not seen as a major problem, Lisa, at the moment for this ECB.
There hasn't been a massive sell-off in the periphery, even though you have seen this move up in the 2-year yield in Germany. And this, I think, is giving the green light to the ECB.
The Italians might feel differently because the 10-year was at 140 at the 1st of March 12 months ago.
2-year German yields were at, 0 or negative.
You're
so
missing
there you
the
go.
lead.
What's that, TK?
Hotel Metropole's opening in Venice.
Oh, here we go. Nice. Did
we
you get
check
the
it out?
notification?
You got a notification?
Paris, then Venice. What else you got on this trip?
Just Venice.
Nice.
Some roses.
It's been a massive pain trade. We've basically had almost no fund inflows this year.
Markets are going to really struggle over the next couple of months.
We see a lot of people embracing that short duration fixed income trade.
The credit markets can really withstand a lot of that elevated yield.
I just want to be cautious. I don't want to buy into something that turns into a bubble.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Before the Super Bowl, we are here with you on a most interesting Friday, staggering to Tuesday and an inflation report. I hope I nailed
You got that.
right.
Well
Interesting
done.
hour. We're going to talk inflation here. Got a lot of other things to talk about. Steve Paglia, you're going to join us as well, owner of the Boston Celtics. We'll go all sport, 8:31. Set your watch. Ferro on Liverpool.
Looking forward to that, 8:31. And then if he doesn't answer the question, I'm leaving.
You can stand up and walk
I'm
out.
gone. I'm just going to walk out. Let's talk about CPI on Tuesday. We've got some estimates for you. Here's the survey. The median estimate so far, month over month, 0.5. That's a pickup. Strip out food and energy month over month, 0.3. That's in line on core. You want some year over year figures, Tom? Still holding on to a 6 handle, 6.2 the estimate there. And for core, we're looking for 5.4. Those numbers drop Tuesday morning.
Important data, and of course, back and forth right now. The equity market's a little bit soft. The VIX out a solid stick, 21.93. Make that at 22. Some yield dynamics. John's mentioned oil, Brent, $86 a barrel. But what we're going to do quietly, and folks, this is the unspoken into the weekend, and this goes back a few days ago when there were reports that people at Goldman Sachs maybe wanted to talk to the board. Our Sri Natarajan reports moments ago, and Bloomberg reports that Goldman Sachs's last key Marcus consumer banking hire, see ya, Mr. Nahar, John, is out the door.
Wow.
He's on a retainer or whatever.
Are you suggesting that we should be thinking about the pressure building on the leader of Goldman Sachs?
Every firm is different. Every firm has different pressures. Deutsche Bank, look at the pressures right now in European banking.
On Credit Suisse,
and
sure.
Credit Suisse particularly. And I don't want to cast any aspersions to anyone here, but it is in the ether here as we go into later February.
Looking at the reporting from Sri, executives debate whether the unit can cut the 2023 loss to $1 billion.
Yeah.
That's a tough time for that unit.
It's a really tough time, and of course with those layoffs and bonus cuts as well. Let's get back to the markets here, John. What do you see in the bond market? And there's a numbers too. I see the German 2-year out to new highs.
Front and centre yields up, both in Europe and the United States. We're back through 450 on a 2-year. Off the back of that, equities down. We can talk about the crude rally, close to 80 at 79.50, up by 1.8% off the back of Russia saying they're going to cut output by 500,000 barrels a day, and delegates from OPEC Plus suggesting to us here at Bloomberg they won't offset it. As we look ahead to the data next week, though, I want to pick up on this tweet from Connor Sen of Bloomberg Opinion. Lisa, you'll like this. The February jobs report is a bigger deal than next week's CPI report. What do you make of that take?
That goes to what Barbara Reinhardt was saying, that the year-over-year comps in CPI will suggest that this disinflation and will have a rapid shift downwards. You might even get a better-than-expected CPI print, but that doesn't signal the strength that will come into play in July when we start getting the June data. And that, I think, is really the key takeaway to what Connor Sen is pointing to. Look at the labor market data. It has a longer run rate of what we can expect.
I think we've had a real triumph of a Friday. It was supposed to be a jumbo. It was going to be a clumsy Friday. And, we don't need to spend the time on it now, but Bill Lee pushing against consensus on China.
He did,
You mentioned Reinhardt of Voya, the ING affiliate. Barbara Reinhardt was brilliant pushing against international consensus there. She's saying domestic. I mean,
Let's
there's
be
some
clear,
real
though,
calls here.
what she is saying, and to Lisa's point, is that by the time we get to July, we're going to start to have a big debate about how sticky this inflation story is. You can maybe surf the dreams, the hopes of the fumes left from the disinflationary story into summer. That might be the view of some of the bears out there. But what she suggested, Barbara suggested, is that once you get to July, and you mentioned it, that you'll look back at a June CPI report, which will, Lisa, indicate stickiness.
Well, and this is the reason why perhaps when you look at the labor market metrics that might have a longer run rate with respect to how to view this recovery, not to say what that's going to do for stocks, though, because stocks will respond in a knee-jerker fashion.
Well, they'll do what they want,
exactly.
Right, based on the misses we've seen and the lack of punishment on those misses from earnings. Do you remember we started the year? It's all about earnings. It's all about earnings, and then it wasn't all about earnings.
Even the bears, though, are coming out and saying, well, you can start selling around 4,200. So they're even kind of pushing back and saying it could have longer
legs. We're
legs.
even discussing 4,200 as a miracle versus
Well, it used to be
3,900
3,900 was the easy seller. Now it's 4,200.
4,064.
Well, I saw the same from B of A, and I don't want to pick on anyone. You know, it's not our style to do that. But when you hear people say there's 20% downside, there's 20% downside, they've said the same thing all year, except the market's 10% higher. You know, it's like it's difficult to take that call and actually do anything with it.
Well, critically, and this is for our global audience, folks, on radio and television, or global Wall Street audience, I should say, they're not going to the bears aren't going to recalibrate, John, until they see that inflation report.
And that's the European equity call from B of A. Credit where it's due. We came into this year, Savita Subramanian said one thing, upside risk to equities. She really believed there was an upside risk to equities, and I think I catch up with her Monday morning, so looking forward to that conversation and just making sure that everything's okay.
John, quick data here. I'm going to look at Chinese yuan, John. I'm going to look at renminbi here, 6.81 yuan, a weaker renminbi this morning. What else do you see in the data?
A CPI, a bit elevated in China, Tom. We'll see if they can respond to that. But overall, the picture as follows. Equities down, TK, by about 0.6%.
Right now, we are briefed. It's been a really interesting morning of briefing here. Emily Rowland joins us, co-chief investment strategist at John Hancock Investment. Are you going to rewrite this weekend, Emily, or do you have to wait till Tuesday, 8:31 a.m. to do the rewrite?
I feel like I should have some good Valentine's Day puns ready for the inflation print on Tuesday. So come back to me on that one. But it is going to be really critical. And this week, it feels like there's been a big shift in the mood music, as you would say, Tom. And we've had higher bond yields. We've had oil prices rising. And most importantly, the dollar strengthening. You know, you think about these moves in currency, the dollar has been at the epicenter of every move in the markets. The weaker dollar trend that started in the fourth quarter really spurring this risk-on rally. And over the last week, that narrative has changed a bit here. So we think that that's going to be really critical to watch. Inflation is going to be huge on Tuesday in terms of the way it impacts bond yields from here.
You look at corporate earnings differently, but the basic idea here of corporate earnings and the resiliency forward, is it there?
By the way, I want to make a comment on what John just said about earnings. It is amazing that some of the huge earnings misses of some of the world's largest companies hasn't even been a big story over the last few weeks. This has been an entirely macro-driven market. So when we look at earnings underneath the hood, negative 5%, 70% of companies having now reported for the fourth quarter, it's okay. But some of the themes are really critical. You know, revenue growth was the major driver of earnings. It sort of saved the day for earnings in 2022. But now we're hearing more about margin pressure. We're hearing about companies dealing with that via layoffs. You know, buybacks are sort of back in the narrative. So, you know, we think this is going to be a tough environment for companies going forward. Costs are elevated, especially the cost of capital having risen a lot. That is yet to be absorbed. And top line growth slowing meaningfully as consumers start to retrench. Companies have too much stuff. We think there's going to be a major war on margins in 2023.
So, Emily, what explains the rally year to date? And do you think we all run the risk of assigning some kind of fundamental narrative to a story that doesn't deserve one?
It's just so hard. It's not based on fundamentals. It's so hard to identify. And you all have been talking a lot about Europe this morning. It's like, you know, I think about it. Before, higher inflation seemed good for Europe because it was better for the euro and better for European businesses. Then we get this miss on German inflation, and that's good for Europe. You know, stocks are reacting positively either way. It's sort of this odd win-win situation that's hard to pin down. And there could be an element here of a technical rally, positioning changes. You know, investors realizing that they didn't own enough Europe, they're short covering, and now sentiment's taken hold, momentum's taken hold, and a lot of investors moving to that part of the market. You know, we haven't fully embraced that trade, admittedly. We've been overweight domestic equities like your previous guest. And that's the reason for that is because it's just a higher quality market, better earnings, more companies with great balance sheets, lots of cash on their balance sheets, a limited need to tap the capital markets in order to grow. That's where we want to be positioned in this environment.
Coming into 2023, Emily, a lot of people were saying this is going to be the year of active management. We've been hearing about that a lot. I'm wondering about the messaging around an active portfolio, about whether this is about avoiding losses or about whether this is delivering outsized gains, and what that tells us about where the sentiment on the risk-reward continuum really has shifted.
Yeah, to us, it's all about risk management in this environment. And it's amazing to see the kind of emergence of the risk on trade, whether it's, small cap equities, cyclical stocks in Europe, waking up in the morning and hearing the headlines around meme stocks rallying again. You got to think to yourself, oh my gosh, we're doing this again. So investors are really moving back in this direction of taking risk. And there's always a sort of celebration of the Fed pivot, or this idea that the inflation is receding and the Fed can kind of see the light at the end of the tunnel in order to pause. And that's really kind of emblematic of every cycle. You sort of see this play out again and again, where soft landing hopes get priced in and then ultimately they're dashed. And unfortunately, we think that is the narrative this time, is the lagged impact of central bank tightening globally is going to start to bite here. So we would be careful about reaching for the riskier corners or pockets of the market here, and we would be redeploying assets in higher quality, more defensive areas.
Interesting.
And
Emily,
bonds. We love bonds.
Have you got a Super Bowl pick for Sunday? I don't know what I'm doing.
Oh my gosh, I don't, but I have really good squares. So I'm excited. I got all the zeros and threes. Yeah, I'm psyched.
Do you know what she's saying there?
What does that mean?
Okay,
No eights.
The brackets.
Emily, what you need to know is John Hancock has two skyscrapers. There's new John Hancock and old John Hancock.
Okay.
Everybody working in old John Hancock has no clue what they're talking about. And in new John Hancock's where all the young hip people like Emily are.
They know what they're doing.
And they do these betting pools where it's a sheet of paper, and it's squares,
and you get
then
a
you
square.
bet, and they all vary a little bit, but it's like, where are we at the end of the first quarter? Where are we at the end of the game?
Right.
They're all vary a little bit, and you put up, a small amount of money. Emily's popping what, $1,000 per square?
It's probably.
I think she's.
I think someone in the office did that last year. I think I still owe them $10.
So how much was it?
It was $100 a square.
Oh my goodness!
Big time.
Congratulations.
It's for charity, though. It's my son's youth. It's for youth football in Marlborough, Massachusetts.
Nice compliance save, Emily.
Emily Rowland of John Hancock Investment Management. $100 a square over.
She bet on Tom Brady.
That's not going to work out this year,
Doing
Tom.
what?
Even I know that. Emily Rowland of John Hancock, thank you. From New York, futures lower. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. A surprise at the Bank of Japan. Bloomberg's learned the Prime Minister, Fumio Kishida, will nominate Kazuo Ueda to take over the central bank in April. That led to a jump in the yen. Here's a professor and a former BOJ board member. Ueda has expressed caution over raising interest rates prematurely. Reportedly, Deputy BOJ Governor Masayoshi Amamiya has refused to take the job. In Turkey, 3 survivors were pulled from the rubble today, more than 100 hours after they were trapped by the killer earthquakes. Rescuers had worked for more than 3 straight days. Meanwhile, the death toll in Turkey and Syria has now climbed to over 22,000. Russia has launched a number of cruise missile attacks on Ukraine today. Ukraine says the targets were critical infrastructure in several cities. Meanwhile, Germany's Chancellor Olaf Scholz has asked European leaders to deliver German-made tanks to Ukraine as promised. The goal is to have 80 of the Leopard 2 tanks there by the end of March. Russia is retaliating. Moscow plans to cut production next month by 500,000 barrels a day in response to price caps imposed by the West. That is equivalent to about 5% of January's output. The news sent crude oil prices higher. And shares of Lyft are plunging. The ride-hailing company says it will prioritize lower prices to attract even more customers. That's a move it expects to shrink future profits. Last month, Lyft cut base prices to keep up with a similar move by the larger rival Uber. Global news powered by more than 2,700 journalists and analysts. I'm Leanne Gerrans. This is Bloomberg.
The problem that you have in the bond market is you still have the Fed acting somewhat aggressively, even though they've had somewhat of a more data dependence. It seems to us as though they're convinced to raise rates at least 2 more times over the course of this year. The problem that you have in the bond market is you still have the Fed acting somewhat aggressively, even though they've had somewhat of a more data dependence. It seems to us as though they're convinced to raise rates at least 2 more times over the course of this year.
Barbara Reinhardt was fantastic this morning, the head of asset allocation at Voya Investment Management, essentially making her case, Tom. This is what she's advocating for. She thinks you get to July, you look back at a June CPI report, and we have a much bigger conversation, debate perhaps, about sticky inflation.
It's been the triumph of this Friday. Friday's about thinking into the weekend and thinking forward. That's why McKee's sitting next to me. And Reinhardt was adamant, pushing against the zeitgeist. Buy America is what she said.
McKee's going to explain how the UMich consumer sentiment data is put together. How it's constructed. It's going to be great. Do you want to take it away, Mike? Do you want to tell us?
They call people up and ask them what they think.
Like 600, yeah, but seriously, like 600 people. They call up 600 people and just say, they go through a list of questions.
They go through the month, so you get some of it towards the end of a month when when some of the news has changed. I don't think we're going to see a big change in the Michigan numbers. Gasoline prices went up. They're heavily affected by gasoline prices in that survey. So we'll see what people's reaction to that is. But the inflation numbers probably won't move much because the inflation numbers had been coming down. Now, you want to ask about CPI next week, don't you?
Take it away.
That's going to be the problem. I got bad news on that score. We're going to see, according to the Bloomberg consensus, a fairly large increase in CPI on a month-over-month basis, 0.5% for the month of January after a 0.1 decline in December. The core is not going to change. 0.3 still gaining in the month of January. And on top of that, the Bureau of Labor Statistics is changing the weighting of the categories in the CPI. They used to do it every 10 years.
And now every
year? Then they moved it to every 2 years, and now they're doing it to every 1 year. So this will reflect last year's weightings. And overall, economists say this is great because it will more accurately reflect what we're buying. But it is going to probably push up the core rate. Omar Sharif says we could see the core rate 2 to 3 basis points higher just based on this statistical change rather than based on inflation.
Mike,
and the Fed's watching the month-over-month numbers.
Well, exactly. Should we stop looking at year-over-year with that in mind?
Yeah. I mean, Mr. and Mrs. America and Joe Biden are going to look at the year-over-year because it should go down because of base effects. But the month-over-month sequential change is what matters to the Fed.
So is a dozen roses here on Valentine's Day and overweight? Is that, Farrell, asking for a friend from me?
Have you looked at the prices?
John is.
He said $500 earlier here in New York.
Well, you're looking at the wrong place. I think that's a little bit high.
But
not that she doesn't deserve it, but that's a little bit high.
I want to dovetail this inflation. Nice say there, Mike. I want to dovetail in this Fed speak that you live every day with the Michigan study this morning, and I don't like the 5 to 10 expectations. I want to look at the 2028 to 2033 expectations. Why do we do that? We have no clue what the expectations are that far.
And the funny thing is, people have come down a little bit in their numbers that they give for what they think inflation is going to be because I think inflation news has been so front and center. But for years, people in this survey were answering, it's 7 or 8%, things like that. And you sort of had to extrapolate out from that what they really meant because people had no idea what inflation is. The expectation here for the 1 year is it goes up 0.1 to 4%, but that is within sort of a margin of error for the Fed. They're looking for stability, not for a major drop.
They're looking for anchored, these words.
Yeah, anchored.
They'll be in the minutes. I'm reading the minutes this time around, just so you know.
Chairman Powell told you so.
Thank you. Anchored and stability. What does anchored mean, and are they becoming unanchored?
No, they've been pretty well anchored. Anchored means that they're not rising out of control. I mean, you could, if you're going the other way, have them falling a lot, but at this point, they're not rising so much, reflecting people's feeling that inflation is going to get embedded into the economy. And you don't want it embedded into the economy. It's a lot harder to get it out. So the fact that they're staying where they are, we're also seeing market expectations drop for inflation over the next year to 2 years, and that is good news for the Fed.
At least I can report that tuition CPI is anchored, as they say.
Is it?
They're putting a chain around men and women's legs.
They're anchoring
the
them.
anchor overboard.
They're anchoring their financial situation. Do I care, Mike, too much about used car prices and car prices in general? Because I've been tracking that so closely, and maybe that's just
Well, you're more fun at parties than other people. But
why are you looking at me?
To know why the CPI is going up
roll.
and down is a kind of a nerd thing, and a lot of people on Wall Street are going to look at that because they want to try to figure out why this is happening, and their bets are going one way or another. But the average American doesn't care. They care about the year over year.
Bramo right now at the party. People having nice conversations, a good time, a few drinks. Bramo rocks up. Let me tell you something. Pulls out the charts.
Okay,
They're not even
Used car
talking
prices.
about markets or inflation. I need to tell you about used car prices right now.
Well, used car prices have gone up a little bit in the most
And
recent
everyone
month.
would be interested.
And,
They would say.
and inflation nerds are worried about this.
Well, that's my whole point, is that actually they were falling for a long time, for a couple of months, and people were saying, okay, this is the big disinflationary push. And now they're going back up because there isn't the same supply left over from the pandemic era and the lack thereof of people who are buying those fleets of cars. It matters. And it matters to people's lives if they want to buy a car.
It matters to the
and it
numbers.
also matters
But here's the thing
the
about
overall CPI
inflation
number.
and the way we talk about it.
Great party.
The price of a used car is still going to be significantly lower than it was. But we talk about percentage changes. So it goes down to a level, goes up a little bit, and there's a percentage change that adds to inflation, but it's not really the kind of inflation we were seeing when prices were just going up and up and up.
Do you remember that scene where the monkeys would be in the boardroom and they'd have the chart and it was pointing in the wrong direction, so they'd turn it the other way and make it look better? And then they all started
That's what
clapping.
we'd like to do.
That's Lisa, except in reverse. Lisa goes and grabs the chart and turns it upside down and then turns around and says,
"What do you think of gasoline prices then?"
Actually, that's been a very interesting thing. They've actually plateaued, right? Which I think is interesting and will support sort of feeling of positions being anchored. But we're seeing prices go up. What happens if gasoline prices go back up? Is that inflationary or disinflationary?
Well, it's inflationary mechanically because the percentage change is higher, and it does have more of an effect on people's spending behavior. But the bad news is gasoline prices went up over the month of January. The good news is they're going down in February. So when you look at the numbers for the January CPI, you're going to have a little bit of a head fake there. One thing we can say is natural gas prices have gone down significantly. So overall, it's kind of hard to make a prediction for energy prices in general. Oil's up a little bit, gasoline was up a little bit, but natural gas prices way down.
The only certitude we have is the three of us combined know 1/10 of what you know about the National Football League. Super Bowl, help out.
We were talking about that. It's an interesting Super Bowl because you've got two good teams and one great quarterback in Patrick Mahomes, but does America really care as much? It's too smaller.
I don't sense that
it's two
they
smaller
do.
cities,
What do
so
you
you
think?
don't get the New York Giants versus New England Patriots kind of ethos, or even the Los Angeles
Kelly
Rams
Clarkson
last year.
at the thing last night was wearing the Dallas Cowboys strap.
Yeah.
Philadelphia's going to love you for that comment.
Well, I mean, I love Philadelphia too, but I mean, it's not it's not the kind of glamorous media matchup that the networks really
Jalen
love.
Hurts has got a nice story.
He's got a nice story, and he's played very well, and they have overall a very, very strong team, and so they're favored now. Kansas City has Patrick Mahomes. So.
Do you think that people would care more if they had Monday off?
Yeah, I don't know. Just do it the following weekend, and just do it on a Sunday, and do it the following weekend where you get the Monday off. I don't get it.
There was some pushback, though, because it would take away from President's Day.
That I don't get either, and I'm not going to weigh in too much there. Do you celebrate President's Day as if it's like President's Day?
Actually,
we used to.
Really?
John, this is a sore topic.
What year was that?
Way back, you had the 12th and the 22nd, and
because we
the
had
22nd was
and you all got
more
together
important.
and celebrated the presidents.
Tom did. Yeah, we were
did.
all at
Lincoln and Washington, and there was a raging debate when they made it sensibly on a weekend to help families and all that. but to a whole cohort of fossils, it's never been the same as actually celebrating 1809.
Do you go on a communist march for
remember.
Labor Day? Like, how does this work?
No, we do that May Day.
May Day, yeah.
May Day,
Okay.
we do that.
I'm just wondering how seriously you take this stuff. I'm not being insensitive. I mean, seriously?
They parade military vehicles in front of Tom's house on May Day.
It just sounds like this is just a Tom thing. Maybe. Brammer's got things to say. Why are you holding back?
Look, I think that
why
we're
are you
running
letting
out
me
of
drown
time.
here?
Well, no,
Back me up.
You
don't
think
celebrate the
No, I
presidents
celebrate
on
it by the
President's
kids
Day.
getting a week off for school,
Exactly.
and then we go
Next.
off on vacation.
Liverpool. Next.
Steve Paniaker
Liverpool.
of Bain. That is next.
Bloomberg Surveillance Super Bowl Friday. Lisa Abramowicz and Tom Keene. There are no two dumber people on network television on the Super Bowl than the two of us.
Nailed
So
that
we're
one.
going to do better than that. We've got a lot of coming up here as well. We're wiring up right now with the owner of the Boston Celtics, and he's rumored to do sports. And we'll talk sports with Steve Pagliuca here in a moment. But first, we're going to talk to him about where the money came from, which is a credit market. And to brief you on the credit market right now, S&P futures negative 20. The VIX was out of stick, 21.54. But I'm going to say this. It's a little bit of an exaggeration, but I'm sorry, yields are moving.
Yeah,
I mean,
well,
that's the way it is.
Up when it comes to the benchmark 10-year Treasury, when it comes to the benchmark 2-year Treasury. Have we seen the full reset in other assets that really moved on the heels of a downward shift in yields earlier this year? And I think that ultimately is really one of the questions. And Gina Martin Adams spoke to that. She said, no. Stocks have not moved in tandem with some of the reset that we've seen in yields over the past couple of weeks.
And in talking to Apollo yesterday and the stub deal they're doing, I'm going to call it a stub. They're taking a stub off of Credit Suisse and bringing it over. The fancy part of the bond market, not trying to make a coupon, not trying to buy a T-bill, the fancy part of the market is still in huge demand, huge interest.
Well, and this to me is really the question. And we heard from Jim Zelter over at Apollo that this is a golden era for credit and people are going into private credit at the same breath that a lot of regulators are saying we're so concerned, haven't seen the full shoe to drop in that area. So where does this disconnect get resolved, considering that we saw a huge outgrowth of this entire sector over the past few decades in the low rate era, and now we're embarking in a very different kind of reality?
I mean, and I look at the yield space, and it's wrapped around. I mean, we've been debt ceiling free this week. Thank God for that, even with the State of the Union. But the basic idea here is, and review this, Lisa. Spreads have come in. The troubled part of the market, IG, garbage IG, and this word distress. Those yields are coming in more closer to the 10-year, right?
Well, let's go back to what Gregory Staples was saying, right? He came out of DWS and he said, you're actually seeing almost frothy credit markets right now. To him, you're seeing the balance of leverage move back to the sellers of the debt. You're seeing spreads come in violently. You're seeing things price really well. So these are sort of the questions. At what point does this indicate that it can't last versus this is, basically the new normal and people are adjusting?
Here's what we're going to do. We're going to talk sports here later in a very generous 25 minutes with Steve Pagliuca. We're thrilled he could join us now. Senior advisor, Bain Capital, not an acquaintance with the only franchise in basketball, Boston Celtics as well. And most importantly, with Jim Zelter, who we spoke to yesterday, the cardinal rule is you can't do fixed income, you can't do debt, if you went to Duke University. You got to go to Duke or you can't do this. Steve, what was in the air at Duke University that got you and Zelter into the debt game?
Well, I'm not really in the debt game. I'm in the private equity business.
Yeah,
and,
I know,
we
same
actually,
thing.
Actually borrow a lot, but Duke's a fantastic place. I'm on the board today, and it's just a great environment and a great learning environment and doing great things.
This moment right now, the jumble that we're in, the day-to-day grind that Bloomberg Surveillance does, give us the vision you have out 1 year on the application of all that money in private equity. What are people like you going to do?
Well, I think you got to step back and we're really seeing, I think as you've talked about today, the unwinding of quantitative easing, and we're back to more normalized interest rates. If we look back at my career in the last 40 years, 30 of those years we had interest rates, T-bills were 4.5%, 5%. It's only as of the crisis that we've had this very cheap money And now that's being kind of unwind, due to the fact when you increase the money supply so much and have so low interest rates, you get speculative behavior and you get inflation. And so now we're in for probably a 10-year cycle of going back to what I'll call normalized interest rates.
In the process of that, I'm curious about the phases of private equity, the phases of taking a company and building it and then cashing in and spinning it off in an IPO. Is it getting harder to cash in and more important to do the due diligence of building up right now at a time when the IPO market hasn't fully recovered?
Well, private equity hasn't totally relied on the IPO market, and the IPO markets are very slow right now. If I step back, I'd say the private equity model, since I've been doing it for, I think, 35 years now, has been a very durable, successful model in bad times and good times, because fundamentally what private equity is trying to do is inject capital in businesses and then grow them. It's a misnomer, I think, starting maybe back to the dark days of private equity, that it was just about taking costs out. The really successful private equity companies have driven growth in the technology sector, the medical sector, industrial sector, globalized companies, and the model has really worked well. So again, when I started out, interest rates we were borrowing money at 11 or 12%. So you're seeing corrections in prices now, and we're still able to finance companies, we're still able to grow companies. You just have to become more selective and more fundamental. And now it's what a more fundamental market versus the speculative market that was created by the vast increase in the money supply.
Over the past decade, a lot of people have talked about private equity and private investment firms in general taking market share from the bigger banks. And we were speaking with Apollo about the potential acquisition of a Credit Suisse arm. Do you see that increase in taking market share? Do you see that likely to continue over the next few years? I do. When they broke Glass-Steagall and changed all the rules, the banks have had to be much more conservative, and banks used to be merchant banks, and now they're really just banks. And large private equity firms are becoming more like the merchant banks of the old, and branching out into debt services, branching out into selling and buying of companies. And so I think those private equity firms will continue to go in that direction.
On Bloomberg Radio and Bloomberg Television, Stephen Pagliuca with us right now, of course, owner of the Boston Celtics. We'll get to sport here in a moment and all the different rumors out there, but we stay on global Wall Street. Steve, I love what you say about the merchant banks have become regular banks. Whether it's Goldman Sachs or, frankly, every other bank, there's a competitive effort to keep the spirit going. Some would say Mr. Solomon at Goldman Sachs has stumbled. Did he overreach by doing something that culturally didn't fit Goldman Sachs when he and others invented Marcus and consumer banking efforts?
Well, I think nobody can get it perfectly. I think they identified that the wealth management market was a great market, and part of the issue is we've seen this great change in interest rates right now, and which made that a tougher strategy. But Goldman has a very good name and a very good reputation, and I'm sure they'll sort that out and be a factor in the money management business because they have the core skills to do that.
Steve, you're just barely old enough to remember when Dire Straits took over the zeitgeist with money for nothing. And as you mentioned in your last answer, all of a sudden money costs something. The Dire Straits rate structure is so over. How does the private equity market change? Speak to the young Turks now in private equity. How does their world change now that money costs something?
Well, I think the world changes in that there was in the last 5 to 10 years, as we've talked, there was a speculative bubble where people believed that everything could be Amazon, that the weight of money and putting money into growth capital companies would gain share, and you could lose money for a long period of time. When money is cheap, you probably can do that, and there were successful investments like Uber and Amazon. But for every one of those, there's been a lot of ones that are just will never achieve the potential. And when you change interest rates, the value plummets, and you've seen that now in the tech market. So I think we're going to go back to the future. When I started, interest rates were, T-bills were 5%. As I told you, we were borrowing at 10 and 11%, and we're very successful. But you have to kind of go back to fundamentals and have companies that gain share and become profitable. because you can't take the strategy of losing money for 5 to 10 to 15 years to then create a great business at the end. It doesn't work in a world where money costs something.
Over the past decade, Steve, we were talking about companies that would borrow money to pay their stockholders, right? There was a lot of discussion around that, and it seemed like the debt side was less valuable than the equity side in many ways because you would get rewarded by the bond side, even in the equity space. Has that balance shifted? Do you see a greater opportunity on the bond side now and the credit side of the companies that you invest in than the equity, or is it just more balanced?
It's more balanced. There's always going to be bigger returns where you create more alpha in equity by driving and increasing companies' market share and profits. But I would say we are entering kind of a golden age of credit, where now credit's being appropriately priced and people are getting great returns on that credit. And it's really, I wouldn't even say it's expensive. It's more of a normal cycle behavior now. We looked at this at Bain Capital. All economies where the money supply increased kind of 50% or more, which is what's happened in most of the Western world. After a period of time, you see large inflation, and it's got to be corrected, and it's got to go back to kind of where the cost of capital is more normalized, and that's what we're seeing right now, and that's going to be a 10-year trend.
Stephen, on the Super Bowl weekend, it's just wonderful that you've agreed to stay with us in our next segment, folks. This will be really most interesting. I want to touch on sports here. I think of Malcolm Glazer, what he did out of Rochester, New York, buying the Tampa Bay Buccaneers years ago. That was an entrepreneurial guy, starting with his father with next to nothing, who made it big in sports. The illusion today is, or the reality, I should say, is there's the haves and have-nots of sports, of big money, whether it's petrodollar money or American tycoon money taking over sports. How do you adapt and adjust to that to do the social good of what a domestic economy wants? Let's take English football. How do the big guys come into English football, like the Saudis in Newcastle, and yet support the domestic people of the United Kingdom?
Well, that's a long, complicated answer. I have experience having been the owner of Atalanta in Italy, and sports can actually be a fantastic change for social good. In terms of specifically the structure of soccer in or what they call football in Europe, it is much more grassroots. It's much more teams can kind of come up and down. And I think what these new owners have to do is recognize their community asset and both try to win, but share the spoils with the teams on the bottom. And I think the UK just came out with a large regulatory report in terms of reforming the system where more money will go to the smaller teams so they can feed the larger teams. Mm-hmm. And then secondly, what's been great about the USA as a leading model is the NBA has NBA Cares, the Boston Celtics. We formed the Boston Celtics United for Social Justice and the Boston Celtics Shamrock Foundation. And we've given millions of dollars back to the community and worked with the community and had our players go out there as well. So sports franchises can be a real impact for social good. And then specifically on the question on the European leagues, it is different than the U.S. It's a grassroots basis.
Yes.
And they're looking at the rules and regulations to really make it be more fair and really support those teams.
On the Super Bowl weekend, we're thrilled to bring you Stephen Peglica. We'll come back and drive this conversation forward. He is the owner of the Boston Celtics and the most storied court in basketball. Stay with us. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The death toll from those earthquakes in Turkey and Syria has now risen to more than 22,000. Experts fear tens of thousands more people are buried under the rubble. Turkish President Erdogan is facing mounting criticism over the country's poor construction record. He has also been criticized for the government's response to the quakes. China is accusing the U.S. of exaggerating the dispute over balloons shot down off the coast of South Carolina. The Biden administration says it was conducting surveillance and has offered evidence it says backs that up. Today, China's foreign ministry again said the balloon was used for civilian use. Bloomberg has learned that Fox has turned down offers of more than $2 billion for its Tubi streaming service. That is more than 4 times what it paid for the business. Fox CEO Lachlan Murdoch wants to keep Tubi because of its false growth. Tubi is a free ad-supported service and and it's free online TV that is really bringing in the viewers these days. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg.
This is the golden era for private credit. Rates have been rising. Economy is doing pretty well. You can get double-digit yields. This is easily the best time to be an investor in new issue vintage credit. The best that I've been here 17, 18 years. You're getting double-digit returns by lending at the top of the capital structure.
From Duke University, Jim Zelter with us here on debt and, of course, on private equity. We're talking to Steve Pagliuca right now, of course, with Bain Capital and co-owner of the Boston Celtics. Lisa Abramowicz and Tom Keene doing a little bit of a wonderful sports vamp here. We'll do this right now with Steve. And with that, we need to bring in someone encyclopedic on PAG's Boston Celtics, which, of course, for me, always Michael McKee is the romance of Mr. Auerbach, and an absolutely original floor in Bob Cousy and what he did long ago and far away. But you are way up to speed on the new Celtics. A couple piercing questions here for Steve right now.
Well, let's just get this out of the way and ask you about yesterday. Mike Muscala coming to the Celtics. You guys didn't do much beyond that. And there was sort of an expectation you might package some of the players or draft picks and pick up some of the stars that have been floating around. You're satisfied just being the best team in the NBA right now, I guess.
Well, we have a great group of players, high character, probably one of the tightest groups we've had in the 20 years that we've been involved with the Celtics, and made it to almost won the NBA Finals last year. We added Malcolm Brogdon, who's been a major plus. So that group is leading the NBA right now, and now we've got some more help with Mike Muscala, and excited about him. So I think we're in pretty good position. As long as we stay healthy, we're in pretty good position for the rest of the season.
A very quick question here, just because everybody wants to know. Jaylen Brown, how long is he out?
He's still being evaluated. Hopefully he'll be back in a few weeks. And we basically won't put players out there if they can be injured. So the doctors are looking at the best course of action, but he'll be back at some point soon.
I got to ask this question. Matt Ishiba walks out of the Board of Governors meeting, shaking hands, new owner of the Phoenix Suns, and a couple hours later mortgages that franchise to get Kevin Durant. Is that the kind of move that is good for the NBA?
I think it's exciting. You can see it's caused a national stir. It's created a powerhouse out in Phoenix. The issue in the balancing act that you always have to do as a sports franchise owner is the long-term versus the short-term. And it sounds like, Matt has a philosophy that they have a team that's on the cusp, and adding a star like Kevin Durant is worth it to mortgage the future. And we'll see how that pans out.
Steve, I got to turn to all the rumors that are out there and drive the conversation forward. And, of course, been briefed by Jonathan Ferro, who truly brings real expertise here. There is an American interest in the Premier League, which I'm speaking as an amateur, is the best-run league in the world, or the most effective league in the world. It seems like every Saturday is a World Cup on NBC. And I'm looking at Manchester United and all the turmoil there. I'm looking at the new ownership of Chelsea. As you look, as rumored, to Liverpool, what did you learn from the Chelsea ballet? What did you learn in the last number of months about how a guy like you from Bain approaches the Premier League of the United Kingdom?
Learned a lot. It was a great learning experience, and it is a fantastic league. As you know, I'm the co-owner and chairman of Atalanta, which is in Serie A, which is a fantastic league as well. So we've learned a lot from that and the Premier League. I think the Premier League has very high values because it's a fantastic product. The television revenues are high. It attracts great players. Now, the Chelsea situation, the price was really a very, very full price, and I think that's motivated some other teams, as you've seen, to try and sell. And I don't know if that value is going to be justified for all the other teams. Long-term sports is a great investment because you've seen it go up year after year after year. It's the only property on television that is must-see TV. And as the whole TV market has changed from linear to digital, and now bundling and unbundling and streaming, these sports products have become even more valuable. So there's a bright future ahead.
Steve, a viewer question. John from Milan emails in and says, "Can Atalanta can they really do better than AC Milan through the rest of the season?" Your thoughts on that, please.
We're very excited about Atalanta. The Bacassi family and the scouts have done a fantastic job bringing in a lot of young players who are very heralded. We have the second leading goal scorer in Serie A in Lookman, Ademola Lookman, and Højlund is a young, now just turned 20 player that's making an impact as well. So hopefully we can be very competitive and be at the top of the league. We have a big game on this weekend, and hopefully we'll win that one.
I feel like, Lisa, it's like when the manager in baseball is banished from the dugout and they're calling on the phone to tell what the plays are. Ferro's in my ear. Yeah, like, ask about AC Milan.
Yeah, exactly.
Ask about AC Milan.
You going to bid out on it? Make them better? No, I want to just build on what you were saying, Steve, this idea that sports products are really attractive to you and that the asset class is growing. And I'm curious what the analog is in terms of owning a sports team, whether it's for the revenues, whether it's for the advertising, whether it's for the social presence, and how you evaluate that. What kinds of investors are appropriate for this area?
Well, you've seen massive increases in sports franchise values across the board, and really that's because they hold value, and because the promise of television revenues and basically branding has been fulfilled over a long period of time. They've created large fan bases. Technology has really changed everything. It's globalized these sports franchises. So when we were growing up, you really couldn't see a soccer game in London. Now you can see it all over the world. And the big sports teams, including the NBA and soccer, which are both global sports, are now counting fans in the hundreds of millions rather than in the millions. And you can use that brand power to monetize it for the sports clubs. Secondly, there is a almost Picasso painting-like aspect of this. There are only 30 pro teams in every sport in the U.S., and there's 4 or 5 big leagues. So it's a very scarce asset globally. Franchises, companies like Chelsea, clubs like Chelsea are very unique in the middle of London there. And so there is a intrinsic scarcity value plus an economic value of the properties because of the television revenues and the central role that they play in attracting viewers in the larger competition, as you see YouTube, Apple, and other tech companies now encroaching on the broadcast space.
Just real quick here, Steve. I'm curious whether Middle East money has pushed out other bidders right now from the London clubs.
You're seeing institutional capital come in, and with these kind of values, that is going to happen. And they have strategic interest in I think, building the brands of those countries.
Right.
And so they're just another factor,
right.
Another source of capital.
Steve, I got to ask one more delicate question here, and I say it with great respect for the way you've done sports. There's a massive uproar about Man City. I was making jokes the other day. It was far more serious than anything we saw with the Houston Astros. How do guys like you help with the arms race and the outcomes that are alleged at Manchester City?
Well, I'm not involved in the Premier League, but if I step back in general, I think a good model would be the NBA, where Adam Silver and previous to him, David Stern, have done a fantastic job in enforcing, fair play rules and making sure everybody has a level competitive field, and that's really the way to do it. And I applaud the Premier League and Serie A for doing the same thing and really enforcing everybody playing by the rules, because at the end of the day, no one wants to have unfair competition or watch unfair competition or have people who are bending the rules or violating the rules succeed. Right. And that's fundamental to fairness in sports.
Right. Steve, I got all of 10 seconds. Eagles or Chiefs?
I love Mahomes, so I'll say Chiefs.
Very good. Steve Hex, thank you so much. Greatly appreciated with Bain Capital and with the Boston Celtics as well. And we thank Michael McKee as well for piercing questions.
For knowledge that we don't have. Let's just call it what it is.
We thank John Farrell for Farrell's in my ear through the whole thing. Ask him about
I want to give him some advice, though. We went to Copley Square for the NBA Finals last year, and they had TVs set up. They need bigger ones because it was so crowded.
You're saying Steve failed. You should have asked that question.
Yeah, Pags needs to get bigger TVs in Copley for the NBA Finals.
We hope you have a great weekend as we celebrate American football sport. We've got much more coming up here. Really, really important day here with good conversation to get you to the weekend. Richard Haas at 12 noon, a wonderful new book.